Do you share her concern?
Not really. I think the banking system has gone through a very difficult 500 basis point increase in short rates, the related deposit sorting, the some of the credit concerns. I mean, there's always concerns, but today the regional banks are stronger. Of course, if you have a real credit meltdown, it's going to impact a lot of people, not just the regional banks.
When you talk about credit meltdown, I was just noticing that we're having the busiest January issuance for investment-grade bonds going back to 2017. How much are companies front-loading this ahead of the election, are front-loading all of their deal-making ahead of what they're expecting to be a lot more turmoil later in the year?
I don't know if I'd call it front-loading. We've been in a recession in investment banking, equity investment banking in the United States for almost 18 months. And the uncertainty with the rate curve, the inverted rate curve, all of this put an absolute damper on capital raising, whether it be debt or equity. And today, there's a little bit of certainty back in the market, and so what you're saying is activity picking up. That's why your guy from Canada was excited. That's why I'm telling you, I think that next year is going to be
It was
better.
more than just excited.
Was it?
Just a little bit. Just a little bit.
Right.
Coming out of the pandemic, things were busy. People were gearing up for a lot of activity. They were hiring. You talked about the recession in banking, certain parts of banking. Are we done with the so-called right sizing, a word that here at Bloomberg Surveillance we hate because ultimately it means job cuts? Are we done with that now, do you think, on Wall Street?
You know, I think what's happened on Wall Street, I do. I think that, in fact, you're seeing a lot of people hiring. In fact, some of the people are hiring are very optimistic as to the rebound that I think we're going to see. But I do. I think that the right sizing is done. You know, in the overall economy, though, what has happened is we're burning through the job postings, and versus, you know, the overall employment is changing a little bit in terms of economic activity. But again, most things point to a rather sanguine environment, which is certainly good for my business. Take some volatility out of it.
Are you hiring?
We always are hiring.
Okay. I figured that you might say that. I'm curious, as you look forward, what's the potential risk case that you entertain most aggressively right now to this case, that we're going to get a soft landing, that you're going to get business come back up, that the certainty that people have now maybe gets shattered a bit? Well, the market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time, especially without a recession. Before we just had rate cuts, 11 straight rate cuts, and we're going to have 5 going the other way in a matter of months. I'm sorry, hikes. It's okay. I confuse it all the time.
Yeah, I do too. Yields go up, prices go down, something like that. But right. So anyway, you know, the long
carry on.
Basically, yeah. I only run an investment bank. All right, what the heck? Come on. Yeah, I can get that right. But the point is, I think one of the risks is that the market is pricing in some aggressive rate cuts, and that supports PEs and that supports valuations. And if you don't see that, you could see some of the PEs and the big tech stocks get hurt a little bit. But the real risk is probably geopolitical, and I'm not sure. All they're talking about here in Davos is, it's my first time, is, you know, this is the epicenter of globalization. Yet, if anything, we're fraying at 80 years of Bretton Woods and globalization, and that could have, geopolitical and real tensions could have impact on the market that it's not discounting today. There's no way.
So given that backdrop, where do you see the biggest growth for you this year?
For Stifel? You know, we're going to grow everywhere and always, okay? And so, look, hey, I've been CEO for a long time, all right? I don't know if I've let you guess, but it's a long time. We started, when I started, we had $100 million of revenue. Today, we have $4.5 billion of revenue. So we're gaining market share. We're just named J.D. Power's #1 advisor satisfaction. That's a big deal for us. So as I look forward, I see continued growth.
Can we pick up on one spot?
Yeah.
The startup economy. just felt like it got decimated in the last couple of years. We saw SVB go under, certain banks, perhaps your situation, maybe looking at an opportunity there. Have you seen the startup economy pick up? Again, you were talking about a rebound in 2024. Is that happening?
Well, it is. I mean, part of the issue, certainly SVB didn't help. They had a big market share. They were the bank that they went to. But we, for example, have hired 40, 50 people to service that market. So we have a big presence in both the Valley and on the East Coast, and we're filling that void. And I see that picking up. What really happened in that market was all the money that came into the economy in 2021 just got pushed to a lot of companies that didn't need it and at valuation levels that were not sustainable. So we're working through that as these companies' cap stacks get redone. Again, it's going to lead to activity in the business. So look, I'm optimistic. You can, well, have me back, and then you can tell me how wrong I was. All right, I won't come back. But no, I am optimistic. I think that. Well, look, last year wasn't fun. All right, so let's be clear.
Ron, it's good to see you.
Hey, good to see you. Thanks
Yield
for
up,
having
price
me.
down. Fantastic to get the education from Ronald Krzyzewski there of Stifel Financial. It's good to see you, Ron. Coming up a little bit later, Steve Tannenbaum, founder and CIO of Golden Tree. The market conversation will continue with equity futures pulling back just a little bit here, Lisa, on the S&P 500 for a second day.
With the biggest risk really coming to fruition just a bit, or at least hoping for some of the Fed officials and ECB officials hoping that, which is maybe not as many rate cuts as people previously expected.
Yeah, real pushback in the early part of this forum in Davos, Switzerland. The conversation on markets will continue. Stay tuned for plenty more. Throughout this afternoon, we'll catch up with the Dutch Prime Minister and the British Foreign Secretary a little bit later in Bloomberg Surveillance.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, is the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from Davos, Switzerland, for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance, the second hour, alongside Lisa Abramowitz. I'm Jonathan Ferro, together this week with Anne-Marie Hordern. It is day two, and on day two, in the last 10 minutes, I have to say, Lisa, just a bit of optimism from the CEO of Stifel.
Which is interesting because he is exposed to a lot of the economy that Ann Walsh of Guggenheim was talking about, and just saying absolutely not. He's been in Groundhog's Day again and again. Maybe we'll see green shoots. Hey, guess what? They're here. He feels like maybe this is going to be a better year.
It's hard to be optimistic beyond that when you start talking about policy, Anne-Marie, and politics.
Yeah, absolutely, especially when it comes to geopolitics. You had President Zelensky here, his last shot really at begging the business world to help rebuild Ukraine's economy, and also to the U.S. Secretary of State and National Security Advisor Jake Sullivan. The president today is going to make his own pitch to the Republicans in Congress for this.
Big push with Zelensky in town. Lisa, let's talk about that, the foreign policy issues and how market participants are going to think about them. You know how these conversations go, and I think a lot of people at home are frustrated with them. Big risk this year, response, geopolitics. Tell me what that means. What are you doing with that in mind? And then it's like blank face, blank face.
Well,
don't know.
That's essentially what it is. It's just a deep uncertainty. I mean, it was oil prices, right? Well, oil prices have fallen to about $70 a barrel. If you take a look at other issues, whether it's gold, okay, gold's been a mystery asset class for quite a while. If you take a look at disruption to risk assets, and the debt didn't happen. So at what point are you looking at something that is an exogenous risk that you can plan for, or that you simply just ignore and hope for the best?
Looking forward to the conversation through the next couple of hours. Lisa will give you the day ahead in just a moment. I want to turn to the markets just briefly. Lisa, looking at equities, down again on the S&P 500. Down yesterday. Pushback from Governor Wally yesterday. Pushback from President Lagarde this morning. We're pricing in too many cuts, seems to be the feeling from policymakers.
So instead of an 80% chance that we're going to get a March rate cut, we now have a 62% chance of a rate cut. So, I mean, it's not as if this is exactly getting priced out of the market, but a little more anxiety sort of coming out as people parse through just how much of a price to perfection market we're looking at.
In the bond market right now, the yield's up by not even a basis point. We're totally unchanged on a 10-year, 4.058%. Bit of a shift in the last 24 hours. I'm not going to completely sweep that to one side, but I'd say some stability in the Treasury market in the last few weeks relative to what we saw, let's say, in October 2023.
Things haven't been swinging around by 20 basis points every day. Today, we're going to be having fantastic conversations. We already have, I've got to say. It's been a tremendous lineup. We're going to be speaking with the RBC CEO, Dave McKay, Chuck Robbins, Cisco CEO. But right now, I've got to say, Steve Tannenbaum of Golden Tree Asset Management, I'm really excited to get his view on the private credit craze that we've been hearing about here, as well as where some of the incredible opportunities are.
Did you hear the whistle of the train?
Yeah.
That was pretty wild.
That was. I thought that was the craze that you were alluding to. I was like, wow, that's good. You have, like, you know,
sound effects.
A craze to order.
Steve Tannenbaum joins us now, the Golden Tree Asset Management founder and CIO. Steve, good to see you.
Thank you, John. It's great to be here.
Let's talk about that massive gap between markets and what the Federal Reserve seem to be implying, what their plans are for 2024. Everyone's weighed in on how we're going to reconcile things. How do you think we will?
So, starting the year, it seemed like you could, at best, get only 2 out of 3. You could have unemployment below 4, growth in the U.S. in the mid-ones, and 6 rate cuts. So it was trying to square that, and that's against a backdrop of a deficit of 5 to 6%. So it just didn't seem to make sense. And then you had a melt up into this belief. So now we're having a walk back. You know, if it was close to 80% in the beginning of the year, now it's 60%. There's a walk back. I think we're probably halfway through the walk back. So I think there's more to go, but you certainly have the easy move right now.
You wonder where that leaves markets. Equities close to all-time highs. Credit spreads still pretty tight when you look at high yield on any given day.
You know what? On the credit spreads, I'm fine with them. In terms of single B, double B, you're still getting pretty good value. One of the ways I like to think of value is what's your spread versus expected default. And at 350 and 7 3/4, given what we expect for the default rate, you're still getting around, call it 200 basis points of excess yield. So I think you could be 50 to 75 tighter in a more benign environment. So the actual spreads don't concern me.
So basically you're talking about how people are saying the biggest risk is that the Fed isn't going to cut rates as much as people expect. You would disagree, and you would say it's that the economy turns down, and that would be a bigger risk. Am I taking that a bridge too far?
A little bit, because there's always stuff to do. But right now, it was priced nirvana, perfect environment. So if the economy slows down, there'll be winners and losers. But right now, particularly ending the year with the melt-up, there was just too much broad optimism.
Well, when you talk about the broad optimism, everyone who we talk to here has been talking about alternatives, private credit. John Rohde did a whole forum on how everybody wants to get into private credit and the expansion of this field. You've been dealing in markets that are less liquid for a long time. Yeah. Does it concern you that everyone's piling in without necessarily the same kind of quality checks that you might get in a public, more transparent market?
So the short answer is yes. The short answer is yes, and the historical returns that you've gotten, around 300 basis points of excess return, I'm skeptical you're going to get that in the future. In terms of what is private credit, first is, it used to be smaller companies called enterprise values of less than $1 billion, $500 million. That's actually expanded. When we look at our private credit book, it's about $500 million of EBITDA, enterprise values of, call it, $3 to $5 to $10 billion. So it's a much larger market. It's when you look at who issues private credit, it's private equity is the largest issuer. And the idea that they're going to leave 300 excess basis points on the table, long term just doesn't seem to, it's nonsensical. So we don't expect that to last. And also there's a lot of competition. Now, when we look at our private credit returns, we had a great year last year. We're seeing interesting stuff. You're going to be solution providers, providing acquisition, financing, providing asset liability financing or liability management financing. So I think there's certainly needs for it. It's where the most innovation in credit is right now. It's a really important point that when you look at like a structured products in the 90s, there was a lot of innovation. Right now, private credit has a lot of innovation. But generically, the excess return, I'd be surprised if the next 5 years resembles anything like the last 10 years.
Solution providers, let's build on that. You're a solution provider if you buy AT1s, and you were last year. It felt like that market might have been killed off by Swiss authorities. You took a different view, a contrarian bet, it paid off big time. Can we just start there before we talk about contrarian bets for 2024?
Sure.
What did you see that maybe others didn't?
It's simplistically the AT1 market's vital. Having owned banks, and we've owned a couple banks where we've been large equity holders, it's private banks. It's a really important financing alternative. And particularly when you have situations which are precarious and you don't necessarily want to put down more equity, having a hybrid security is a really valuable alternative. So the idea of, of eliminating that and having the hybrid security actually be a hedge you lose and tails I win type of investment, because if it doesn't work, you get the same downside, and if it doesn't work, you have no protection. And if it does work, your upside is less. Doesn't seem like a good alternative for the regulators. So our view was simple. Simple names are already working. This market's going to come back. The regulators, and we had a strong view since we've had a couple of these banks that have already been regulated, that they are very much in favor of having a lot of choices. So we felt that it was a relatively easy trade. In fact, what I felt my biggest mistake was thinking it might last longer than it did.
It sounds easy now looking back at the time. It was not easy. I think, Lisa, you and I were talking about this at the time. It felt like maybe we'd see a real loss of faith in some of these products, these securities.
I just remember just seeing the valuation tank.
Big time.
So it sort of goes to the whole idea of easy money being made. It's really easy to say that in retrospect.
There's nothing easy about this.
So one of the interesting things, this was against a backdrop where the return on equity of European financial stocks was going to be the best it's been in easily since 08, since the crisis. So that was also another nonsensical. So you have really good earnings, the profitability, whether it's through cleaning up the balance sheets. We saw that during the pandemic. There weren't excess charge-offs, to being levered to higher rates. So the return on equity had gone from, call it, if you look at the SX70, had gone from, call it, the mid-single digits to the double digits. And then the AT1s weren't going to work. That just didn't seem to me fundamentally to make sense. Or maybe to put it a different way, I've never seen that happen in my career, you know, where the junior securities haven't done well when the underlying profitability is improving.
So is there anything else that's like that right now? Just you can tell us. There's nobody watching.
Easy money for
Exactly, please. Thank you.
You know what? I do think the single B, strong single B, double B is very reasonable. I think the preferred market, so when you look at DirecTV just did a deal in the high 400s. I think that's reasonable. You look at a Valeris, an oil service company, reasonable. So I think that there's a whole bunch of names that are, call it, in the high single digits, loan to value of below 50%, that I think are very reasonable compared to equity values. You look at the preferred stocks, also very reasonable. Some of the larger issuers that are trading around 9-10%.
Do you think that credit is going to materially outperform equity this year and has the potential to for a prolonged period of time?
It usually does early in a cycle, with the pandemic being the one exception. If you look at the past few cycles, I think it's certainly a reasonable asset class still. When you look at, you know, it's a higher quality asset class than it's ever been in terms of the mix of double Bs versus triple Cs and single Bs. And you're getting, you know, the index is yielding about 8%. So that's not to say you won't get better opportunities, but as a entry point, I think it's a reasonable entry point.
Steve, everyone in Davos has been talking about the elephant in the room, which is the former president potentially coming back into power. How are you thinking about business if that was to be the case?
So I view this as like game 4 of an NFL season, okay? So it's really hard, you know, to think about who's going into the Super Bowl, who's winning the Super Bowl when it's only the 4th week. So I think there's just too much to be decided. You know, if you look back the first time, there was a lot of concern, apprehension that didn't necessarily materialize. So, but there's just a lot of data points to look at, who the running mate is, et cetera. And he's proven to change his perspective, and so it's really hard to. In the 4th week of the season, you know, to be placing too much conviction in anything.
There's a guy I've got a lot of respect for, Mark Dow. He's in the market, and he always said back in 2016, it's really difficult to divorce your political bias from your market views. Yeah. When it came to 2016, I think the ultimate success, or at least the ultimate successful playbook, was just to try and divorce exactly that. Focus on the policy and don't focus on the volatility that comes with the man. Can you do that this time around?
Listen, always easier said than done.
Absolutely.
My guess is it's only the 4th week, and we're tired about hearing the scenario analysis played out. So my guess is a lot of these themes will be beaten. And then it's also, you know, it's really unclear what the independents, which are the largest group that they've ever been in terms of the electoral body. So or the U.S. population. So I just think that it's really hard to focus until you're, I'm going to say, 60 days out, 90 days out.
It's Monday night. It's October. Apparently.
Yeah.
We can't talk about the Super Bowl yet.
Well, we will talk about the Super Bowl. I think that everyone here is just sick of it.
Hey, Steve, it's good to see you.
It's great. It's great.
Thanks for catching up with us. Just fantastic. And congratulations on this success in the last 12 months. Stephen Tannenbaum there of Golden Tree Asset Management, taking that contrarian view on contingent convertibles in Europe.
I loved that trade, and I love that you asked him about it, because it did.
I love that he's like, it's so easy.
I know, exactly, but it felt like the sky was falling, and everybody said it looked like the Swiss regulators just killed off this market single-handedly. Forget it, get out. And you saw all these asset managers do that. And who was on the other side? This guy.
Without a doubt. Coming up next, in the next hour, Amir Yaron, the Bank of Israel Governor, the Dutch Prime Minister, Mark Rutte, and UK Foreign Secretary, David Cameron. All of that still to come, live from Switzerland, from Davos, at the World Economic Forum. This is Bloomberg.
for Trump. Britain's next.
It was going to keep Real World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in New Hampshire, only on Bloomberg.
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downsides. But we have to be extremely attentive and anticipate, just as we do with inflation.
That was ECB President Christine Lagarde speaking with our own Francine Lacroix on the potential concerns of a Trump re-election. A little bit earlier on today in Davos, Switzerland, Governor Brian Kemp, Republican from Georgia, spoke to us about Trump's big win in Iowa.
That was a strong win in Iowa, no doubt, but some really bad weather, very low turnout. So we'll see what happens here in the next week.
When you look at the election, what are you looking to understand whether Trump 2.0 is going to be the same as Trump 1.0? Is this going to be a different type of presidency from everything that you've gathered?
Well, look, I don't know. You probably have to ask him about that. I've said for a long time now, we need to be forward thinking. We need to tell people, what we stand for, what we're going to do. We don't need to be looking in the rearview mirror and relitigating the 2020 election and really, lay out for the American people what it is we're going to do for them to help fight through, 40-year high Joe Biden inflation, disaster at the border, the weakness that we're seeing in the world, and a lot of other things. And that's what I've been urging the candidates to do, and that would go for former President Trump as well.
But former President Trump wants to relitigate 2020. He was just talking about it last night. He goes back to your state of Georgia, as you know. He wants Fani Willis, the district attorney, to be removed. There's lots of questions about potentially a relationship she had with the prosecutor. How are you going to weigh in on that?
Well, I didn't say always listen to what I said. I was just saying what my thoughts were, and that's for every candidate to decide. But look, there's some... months ago, I was warning people there wasn't evidence to go after Fani Willis, but now there's some troubling things that have been, accusations that have been made, and I think the judge will get to the bottom of that. That's playing out right now. We've got a legislation we passed for district attorney oversight that ended up in the courts, and so we're going to have to re-legislate that this year, which we're in the process of doing right now in our legislative session. But there's ways to address that, and we need to let the legal process play out.
But do you think Willis should be removed?
Well, I wouldn't be able to speak to that because I haven't seen the evidence, but I think at the very least, if the accusations are true, it is very troubling, and I feel certain that the judge will rule in the right way to make sure that, President Trump and anybody else is being treated fairly.
So let's go back to what the timeline is going to look like for the political space in the United States. You say a lot of those candidates are not ready to coalesce just yet around the former president. What I'm hearing is everyone's waiting for New Hampshire. Let's give Ron DeSantis, Nikki Haley some space. But if Trump wins New Hampshire, is that a time when you're going to say, okay, I'm ready to endorse him?
Well, I think it depends on kind of what happens, how big a win it is. If that happens, if somebody else wins, what happens? I mean, I wouldn't want to speculate on that. I know I'm staying focused on the great state of Georgia.
Very diplomatic. Governor Brian Kemp of Georgia there weighing in on the former president of the United States, Donald Trump, and the prospect of him taking back the White House. Let's have that conversation right now with Mark Champion of Bloomberg Opinion joining us from London. Mark, as you know, as you can tell from the outside looking in, lots of conversations here about the potential future president being Donald Trump, what that would mean for European defense. Mark, can you help us understand what the Europeans have been doing for themselves over the last 4 years? Have they been boosting defense spend? Are they in a position to depend on their own military and not America's?
Yeah, that's a slightly graded answer to that. First of all, they have been increasing defense spending more or less since 2014, with the first annexation of Crimea by Russia. The question is whether they've been doing enough. That's a very different question. There was a huge wake-up call in 2022 with the invasion of Ukraine, a lot of commitments to do enormous amounts, 100 billion promised by Germany, for example, for defense. But the actual delivery has been much, 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 less than that. It has to be said that, last year, the U.S. had been taking the lead in arming and financing Ukraine, but by the end of the last year, the Europeans had overtaken the U.S. quite handsomely and were doing the lion's share of the work. It's a fairly complicated question. One thing that's clear is that the Europeans will know what to expect when Donald Trump is elected in that sense. If he's elected, then they will know that, he's no great friend of NATO, he's no great friend of Ukraine, and he's no great friend of theirs.
Mark, let's talk about those billions of dollars and that aid that's been going to Ukraine right now. 100 billion stalled in Brussels and in Washington. Biden today is going to make the pitch to House Republicans that they need to sign off on this. But I want to get a sense from you. You spent a lot of time in Ukraine before and during the war. How much longer can Ukraine go without that aid coming in from Western allies?
Well, the Ukrainians will go on fighting no matter what. It's just that it will be a lot uglier. They will lose a lot more people. And eventually, if they don't have artillery, essentially, if they don't have artillery shells, they don't have the barrels to replace, on the guns, they simply won't be able to compete. And the Russians will be able to push forward, probably quite slowly, but it will be brutal. The great thing is to understand, I think, that until the Russians feel that there's no further they can go, the war will continue.
Mark, we're talking all about sort of global kumbaya at a place like Davos, which celebrates globalization and cooperation. How much, though, when you look at the individual countries in Europe, are they also struggling to really get on board with Ukraine aid, also struggling with how much they want to get involved with the Red Sea and fighting the Houthis, and also kind of pushing back and saying, we need to really focus on our own countries and make sure we can compete in a new era?
Yeah, no, absolutely. So, the problem in Europe is that you just have one country standing in the way of the release of 50 billion. That's Hungary. In the coming weeks, that will probably get sorted. Either Hungary will be brought around or it can be circumvented by taking the fund outside of the EU institutions. So one way or another, that will probably be done. But the other things that you referred to, these are perennial issues for Europe. With the Red Sea, the French said they didn't want to be part of a coalition where they might be led somewhere they didn't want to go by the US. More broadly, the French have been pushing, for a long time for a kind of autonomous strategic strength for Europe where they would be able to act without the US, but they're still such a long way away from getting to that point.
Mark Champion of Bloomberg Opinion out of London. Mark, thank you. Kumbaya. I get the feeling that this time around, I don't feel that anymore.
No, I don't either.
Lisa, I've been coming here for much of the last decade or so. Haven't been here since the pandemic. And I get a real feeling that they've had a massive reality check at a place like the World Economic Forum. That the globalists, as people like to call them, that come to an event like this, have seen their model fracture. And they've seen, in many places, not just fracture, but views they used to have break because they've been so challenged. I think for a lot of people in society, the credibility of a lot of these people is absolutely shot. And trying to rebuild trust, I think the theme of this year is really, really interesting. I know what it's meant to mean, but rebuild trust with who? I think we need to rebuild trust with society at large between the establishment and the people, because throughout the pandemic, that broke big time.
It seems like there is sort of the establishment and the people, and that's the political angle. And then there's the business angle, and people are here to do deals. And we could see that. And the politicians who are here are also here to do deals, like Governor Kemp looking to meet with some of the auto manufacturers more globally. So to me, this has really just turned into what the meat of it was, which is a deal-making opportunity to rapid-fire meet a lot of people at once. And yes, the parties and all of that, but it seems much more transactional and focused.
Well said. I see it exactly the same way, and I think the conversation we had with with Mike Wirth of Chevron was a great example of that. And again, this morning, we've seen that time and time again. Governor Kemp of Georgia is pushing his state to have a much bigger role in the U.S. economy. From Davos, Switzerland, this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from Davos, Switzerland this afternoon. Good afternoon. Here's the price action on the S&P 500. Softer yesterday, lower again today. We're down on the S&P. We're down across the board. On the Nasdaq by 0.4. On the S&P 500 by 0.3. The small caps negative by 1 full percentage point. A bit of negativity, some pessimism in the first couple of days of the week as central bankers worldwide push back against rate cut expectations. In the bond market, 2-year, 10-year, 30-year. The scores in the Treasury market shaping up as follows. Yields unchanged. At least we're on a 10-year still with a 4 handle. On a 2-year, let's call this 4.28.
Basically, this is not moving at all compared to what it was doing back in November and December. I just want to sit on Governor Waller's questions for a moment, his comments, where he really pushed back. He was reiterating what we've heard from every single person who's come on this set over the past couple days. And to me, at what point do we price out something more than just a 62% chance of a Fed rate cut in March, but maybe something that's less than 0.5%?
Let's get to those comments from Governor Waller. Under surveillance this morning, Fed Governor Christopher Waller calling for rate cuts later this year. Waller saying yesterday, quote, "When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully." The comments easing traders' bets for cuts starting in March. More Fed speak coming later from Barr, Baum and Williams. All of that still to come. Lisa, the message, I think they're all on the same page. They're varying different ideas, I think, of how much we should do this year, when that should begin. But ultimately, the pushback is March is too soon and 6 is too much.
And this time is different. And this, to me, really stood out from Chris Waller's comments. He said, with economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past. This time is different because they're not facing off with a crisis, which means that soft landing that everybody is looking for does not come with 6 rate cuts or even 5 or maybe even 4.
It's not just pushback taking place on that side of the Atlantic, on this side as well.
Yeah.
ECB President Christine Lagarde with a few things to say about ECB policy. What she's saying is what we've been asking. When the market starts to tell you this is how much you're going to cut by, the market makes it difficult for you to achieve your inflation objectives through the easing of financial conditions. That's not just a story for this Fed in the US, it's a story for Europe and the ECB.
And the fact that she said the quiet part out loud, does that mean that people start to believe it? Because on the margins, you're seeing yields creep up in the Euro region once again, but not significantly, and you are seeing deals getting done. Like what we were talking about, what Davos is about, right? The deals are getting done, and it's feeling more optimistic than it did over the past couple of years, much maybe to the chagrin, it may be moving too quickly.
We heard that from the Stifel CEO. I think this conspiracy theory that somehow these people here have the world on strings. Anne-Marie, they wish. They wish they had the world on strings. They don't anymore at all.
No, when you look around, especially with some of the decisions that have been made or the lapse of judgment we've seen or, you know, a missing of a Secretary of State by a certain president administration, to think that there's some conspiracy theory and cabal going on in Davos just get thrown out the window. But to Lisa's point, deals are being made on the sidelines, but also this Davos has really become a foreign policy forum in some ways as well. You have almost every single foreign secretary here. We're going to be speaking to David Cameron, and President Zelensky is here, and he's really trying to rally the West once again as they go into 2024 without the money they need to continue fighting Russia.
Let's talk about that right now. Zelensky meeting with leaders in Davos in a bid to shore up his country's defense against Russia. The push coming as US aid continues to stall on Capitol Hill with a growing focus on Israel and the Middle East. Zelensky addressing a wider audience, but also having more direct conversations with Jamie Dimon, Ray Dalio, and Anne-Marie, Steve Schwarzman.
Well, he went up to Zelensky, Jamie Dimon, and said, "Hi, I'm Jamie Dimon. I'm the CEO of JP Morgan." Of course, Zelensky knows exactly who he is. Those conversations for Zelensky are just as important because he's trying to rebuild the Ukrainian economy. But the big topic today is happening in Washington, D.C. President Biden is hosting Speaker Johnson, and the main topic is going to be you have to push this Ukraine aid through. And Johnson says, "I cannot do that with my Republican caucus if you're not going to get on board with a border deal."
I love that where public sort of officials can't get things done, people look to the private officials to fill the gap. And I think you're seeing that on full display here. That on one hand, we're seeing all of this disagreement over whether you can pass aid in Washington or in Europe. And then he's just going to go straight to some of the richest people in the world, some of the top bankers, and say, you guys help out, because frankly, it doesn't matter where it comes from. And they would like some of the stability to really continue.
Just to talk about Ukraine just a little bit more, Ukraine's just not on the front page anymore, particularly after the events, the tragic events that took place in early October and the tragedies that have unfolded since then in the Middle East and in Gaza. They're just not on the front page like they were a year or so ago.
And how many articles have I been reading about who's to blame if Ukraine loses? What happens? Who sort of fills the gap? Does Russia start invading other countries? I mean, there are all sorts of theories that are being thrown out there. It still isn't getting the front pages, and that's even more so with Trump potentially becoming president once again.
Should we get to a lighter story and finish on this one? Apple somehow surpassing Samsung as the world's top phone maker for 2023. Samsung losing the top spot for the first time since 2010. Apple's iPhone accounting for a fifth of the global market, but taking the top spot over all, despite a lukewarm reception to the iPhone 15 in China. I was surprised by this, Bramo, given the difficult year that the iPhone just had, particularly in China.
Well, this is the reason why I'm actually looking forward to. We're going to be speaking with Qualcomm CEO coming up, and the whole smartphone recession that we've been talking about has been hitting everyone. We've been focusing so much on the iPhone because of the Apple stock performance, if nothing else. But they are taking share. And this really goes to the heart of the question around their China role and whether really you can see any competitors push up the other way. And it also raises a question, can you diversify away from the iPhone if that's really the product that they're associated with most of all?
And of course, when you look at what Apple is doing in China, they're cutting their products by 5%. When you buy an iPhone in China, it's going to be 5% cheaper because they're so concerned with Huawei. So maybe at some point this also becomes an Apple Huawei in China, less so Samsung.
Haven't upgraded yet. Sticking with it. iPhone 12 for life. For as long as the battery lasts.
Good luck with that.
For as long as it's a 12. For as long as the battery lasts.
You haven't cracked it?
We're sticking with it. No, it's still going. We're doing okay. I'm going to crack it now.
I was about to say, you're like this.
Let's kick off the conversation with Steve Cheverone, Head of Multi-Asset Solutions over at Federated Hermes. Great to catch up with you, Steve, as always. Steve, we're hearing a lot here in Davos about people pushing back against rate cut expectations. Are you on board with them?
Yeah, but look, we sat down, I think it was the first or second day of the year, and we said that 6 just isn't going to happen. I mean, at least not according to our view. You'd have to have material economic weakness to get 6. We've always said we thought that number was more like 1, 2, particularly because, and if people forgot, they got reminded this week, this is a presidential election year. And historically, the central bank does not like to move between July and November of an election year. So it really only leaves in our mind May, June, maybe December for cuts. And that's fine. And I think that's positive for the economy, but the market just got ahead of itself in the fourth quarter.
So what needs to reprice, Steve? I mean, this is sort of one of the questions that we keep hearing from people where they say stocks seem overvalued. But Steve Tannenbaum of Golden Tree said credit seems fine to him. Do you agree?
Yeah, I think bonds are what really got ahead of themselves. If you think about the bond market, having rallied all the way from 5 to sub 4% yields at their low, and how tight credit spreads really kind of came in, it's the riskiest parts of the bond market that are the most expensive. Go over to equity land and it's the opposite, right? The cyclicals that were pricing in recession last year are still cheap relative to the broad market. The dividend payers that need lower rates are still cheap relative to the broad market. And then look at kind of high beta areas like small caps and even EM with the data out of China today. Those are as cheap as they've been in years. We think there's still relative value in pockets of the equity market, much more so than in the bond market.
Okay, so do you think that right now is a time to actually sell treasuries and buy stocks, buy even consumer cyclicals and things that are leveraged to the soft landing, but maybe not going to be as vulnerable to the non-rate cuts?
Well, that's how we're positioned. So we're neutral in cash in our portfolios, Lisa. We're underweight fixed income, and we are overweight stocks by the tune of about 5% for that reason. Now, right here at this point, with bonds, the kind of 10-year over 4%, we're neutral-ish. We expect you could see some more pain in the short run on yields moving higher, maybe towards that 4.5 level. But if you go out 12 months, once those rate cuts do start, even if they're modest, we think we'll see yields fall. So we kind of made that move, when we had a 3% 10-year yield. Right here, we'd be a little bit more neutral-ish on making a new move.
Steve, we spoke to Ann Walsh over at Guggenheim a little bit earlier on today, and she flagged the regional banking issues of last year and says they've not gone away. They're going to linger. That problem might return. Steve, where are you on the financials, and how do you feel about the smaller banks at the moment, given the bounce they've had over the last few months?
Yeah, well, before I answer that, John, just be aware your phone battery is going to start getting much shorter after your comments a few minutes ago. I just wanted to make sure you were clear on that one. No, look, I think our view on the economy is one that slows a little bit, but not one that weakens materially this year. Just like our view on inflation is one that eases but doesn't go in a straight line of 2%. That doesn't mean all the banks are out of the water here, but our view is that they're going to be okay, that the pressure on deposits has probably peaked. When rates fall, that should ease some, that there will be some credit stresses in the economy, particularly amongst lower quality borrowers. but not broad, not some kind of massive kind of credit deterioration or rapid rise in unemployment. So we think they'll be okay. And we're watching the financials closely because if you have a market that's marching to new highs led by financials, that looks a lot more healthy than a market that's marching to new highs led by your most defensive names. That's what's been happening since kind of October, November. We'll see if that continues over the next couple of months. But that's a key thing to watch in the coming months and weeks.
Steve, do you see good reason for that to continue? In a world where you might get softer growth, I don't know to what extent. You might get lower rates, I don't know to what degree. But in that kind of world, where do I want to be in the equity market?
Yeah, John, my motto for the year is better is better. And I think when you look at where the rate cut expectations are coming from, or you look at where some of these names are priced, it's not one cohesive market view. There's folks that are in our camp that see a kind of just modest slowing, but still constructive background for the economy. And then you have folks that are pricing in recession. That's how you get to the 6 cuts. You're not getting there, I think, on folks that see a more modest view like us. And so I think what you're looking at in this market is one that on the headline level is pretty normal. It's 5% cash yields, down from 5.5% on a couple of cuts. It's bonds earning their coupon. It's equities growing with earnings. It's underneath the surface, though, where you see some real action. And again, it's those parts of the market that were priced for recession or rates being higher forever. Cyclicals, small caps, dividend payers. And yes, I think there's a point here where EM gets beat up so much that you just have to take a valuation flyer. And that's why we're modestly overweight there as well.
Steve, is this going to be an exciting year, or is it going to be a year of just sort of grinding it out and getting single-digit returns?
It depends on which parts of the market you're invested in. We think it is boring. So you've seen headline indices, kind of move 20 plus or 20% plus or minus over the last 5 years. We don't expect that. We think it's more like a kind of high single-digit, maybe low double-digit return at the index level. But again, underneath, look at those small caps. They're 30% off of their high from 2 years ago. They would need a 50% move just to get back to where they were 2 years ago. So we think it's exciting underneath the surface, but the surface level is going to look calmer than the turmoil underneath.
Tim Cook is listening. The battery's running low. Started in the last 15 minutes.
I told you.
Steve, I know. The conspiracy, is it one? Steve Chevron at Federated Hermes. Steve, thank you. On Apple, on tech, the financials, and so much more. No drama, Lisa, seems to be the message from Steve. Take it. Don't make it worse than it is.
Yeah, stop being overdramatic. Just
right?
Enjoy it. It is what it is. Even bonds, he's like, yeah, they might sell off. It might hold to 4.5% for the 10-year, but they'll come back down eventually. What's interesting to me is the small cap and the regional banks basically seeming to lean in based on how much they've sold off. That's interesting to me.
If you do get leadership from a different part of the equity market beyond big tech, I think most people would agree with Steve. That's good news. It speaks volumes about the economy. If you're getting leadership just from a narrow set of 7 companies, that's not a reflection of what's happening in the broader U.S. economy, is it?
Which is exactly so, which is a reason why I think a lot of people are saying we've already seen a recession. It was a bad year in 2023, even though it looked like a great year. And this year you could see a recovery, even if on a headline level it doesn't seem quite as great.
Did you get the feeling people want to talk about Donald Trump yet?
Not
Davos,
yet.
Switzerland?
Not quite.
It's not happening, is it? It's not happening. Keep on asking. Keep on getting blank faces. What did we hear earlier this hour? It's the 4th week of the football season.
Yeah,
you guys want to talk about the Super Bowl. Well, of course we do.
Yeah, that's what happens. Because the Europeans are trying to prepare. They're running around panicked.
Without a doubt. Dave Mackay, President and CEO at RBC, coming up next. This is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. New time starts Monday.
Of soft landing in the U.S. are increasing as time goes by. We do believe that inflation will get towards below 2.5% core PCE by the end of the year.
That was Dan Pinto, the JP Morgan Chase President and Chief Operating Officer, on the outlook for inflation, and maybe a sprinkle of Fed policy views coming from Dan Pinto as well. Everyone's got a view. They may well likely start cutting interest rates at some point this year, probably not March, and ultimately 6 is too many cuts. The price action at the moment looks like this on the S&P 500. Lower yesterday, again today. We're off on the S&P 500 by, let's call it, 1/3%. Yields just creeping a little bit higher, Lisa, up by a basis point, not even 4.1%. today.
Really not a lot of drama. That's all I can say. There isn't a lot going on when it comes to economic indicators. You do get retail sales today. But really, some of these macro questions are not going to get resolved in a week. It's not going to get resolved in a month. So right now, it seems like people kind of trading sideways and adjusting around the edges.
Going to try and resolve some of those issues in 5 minutes right now with Dave Mackay, President and CEO of RBC. Dave, good afternoon. It's good to see you.
It's good to see you in Davos.
Great to catch up with you, sir.
Yeah.
We've had some difficulties in banking in the last 12 months. We've seen it play out, particularly in the United States in the spring of last year. Some banks were in a position to go on the offense. JP Morgan won with First Republic. You've also gone on the offense. You've taken over the business of HSBC up in Canada. Let's start there. Tell me how that's going and why you seem to think you're operating from a position of strength and maybe even on the front foot in 24.
So our currency is very strong. We're incredibly excited about HSBC Canada. We received approval for it, regulatory approval, in December. We just announced that we're going to close the transaction at the end of March. It's a close and convert, so we can convert the entire client organization onto the RBC platform at the end of March. So we're very excited about that, and it continues the growth story for RBC. We have one of the strongest valuations of any bank in the world on a price-to-book ratio. We're one of the largest banks in the world from market cap. So that strength, that capital strength, allowed us to take advantage of HSBC's decision to leave Canada. Their 7th largest bank, roughly $80 billion in assets, 750,000 clients are all migrate over to RBC. But what they do really well is they're a fantastic global, internationally connected bank, cross-border bank, multi-currency accounts, trade finance capability, global view. And all that capability comes over to RBC, where we weren't as strong. And not only do we bring the clients over with that capability, we get to offer that trade finance, that global view capability to 15 million of our existing clients. Second thing it does for us is we take that franchise, we put it onto our tech stack, the RBC tech stack, and we are able to offer all the investments we've made in whether it's online banking, mobile banking, trade finance, treasury management, cash management. The HSBC clients will have access to a broader suite of product, a broader suite of capability, more channels to access. So from a client perspective, from an employee perspective, it's a big win. And from a shareholder perspective, it's incredibly accretive to RBC. We're a 14.5% CET1 ratio now. It's going to be roughly 240 basis points of capital. It's incredibly accretive to the organization. Boosts our ROE, which is around 16%, significantly well into our target range. So it's accretive for the shareholder. It's good for clients. It's good for Canada. We'll pay more taxes in Canada. We'll pay more dividends to shareholders. And therefore, we're really excited about the growth story that this presents for RBC.
The two things you said there, Dave, that you repeated actually, trade finance, global view.
Yeah.
Here we are in Davos, Switzerland. How challenged is trade and taking a global view at the moment?
trade will always exist. It's whether it's a regional view of trade, a lot of geopolitical commentary about supply routes, transit routes being challenged, obviously, and we'll figure that out over time as we think about our trade partners long term and we rebuild and rethink trading blocks. Trade will exist, and it may look different today and have some components of the world today and some components of the world tomorrow, but it's always going to exist. We have to, as a society, take advantage of our relative differences and our relative advantage. We have to keep inflation out of our economies, and global trade and global access to trade has allowed us to operate our economies much more efficiently. So we'll find a way. It just feels a little cloudy right now.
Literally. I am curious, as you talk about HSBC and this idea of integrating the Canada business, what's next? Who else are you going to acquire?
Well, we just acquired Brewin Dolphin in the UK 18 months ago. We're the third largest wealth manager in the UK. We're the sixth largest wealth manager in the United States. And we're the #1 wealth manager both on distribution and asset management in Canada. So we're building, most people don't know, we're building this fantastic global wealth franchise. So when we think about acquisition and M&A, very much our global wealth franchise is part of that, whether it's in the United States or in Europe. We're thinking, how do we roll up more capabilities? Very fragmented in the UK, as you know. So there's opportunities there. So building out that global wealth distribution franchise predominantly is important to us over time. We'll generate significant excess capital, even more so with the HSBC acquisition, rebuilding our capability to do a cash transaction with our capital. So wealth management is a major focus for us.
What's interesting to me that you said was that it was not investment banking, that you are interested in further wealth management acquisition targets, but a lot of people are wondering what's going to happen to all these regional banks, and there needs to be some sort of roll-up, and you're not involved in any of that. That's what it sounds like. Why? Are you concerned about some of these banks?
We have a fantastic regional U.S. bank and City National Bank in California. It's a $75 billion bank by deposits. It's been a challenging year for regional banks, including City National, with deposit betas changing, with costs increasing from a profitability perspective. We missed our targets. We're rebuilding that performance over the coming year, and I expect us to reach our proper run rate by the end of the year, early into next year. But the regulatory environment's really uncertain in the U.S. The rules around liquidity, the rules around capital, the Basel III Endgame has probably been a topic on this show all week. When those rules are resolved, and all we're looking for is a level playing field. Canada's already moved more aggressively to a Basel III Endgame, so we're looking, are we pulling up to where we are? Are we coming down to where other global players and other global economies? So that certainty is really important when you value an organization and understand the deposit flows and where they're going. The deposit story in the United States is still challenged as well. So I think I would need more clarity on those outcomes before I could really value a U.S. franchise right now.
So are you interested in expanding in the U.S. at all right now, or is it not really the most fruitful place? Is it other places in wealth management that are more fragmented that you see a greater opportunity?
We have significant opportunities to grow in the U.S. on an organic basis, whether it's our ninth largest capital markets business in the United States. We're seeing greater ECM activity, DCM activity. The rate environment's becoming more constructive for that business. So growing our capital markets operation by bringing in teams, expanding our sector coverage. We're doing well there. We're hiring teams and lifting out teams in the U.S. wealth franchise. We have $550 billion of AUA. We're, as I said, the sixth largest franchise, national franchise in every market. So again, organic growth. We brought in $25 billion in AUA last year alone, largely through team lift-outs and new clients coming in, and growing the City National franchise at the same time, which is a real focus on the entertainment business in California, selectively growing that business. So we see significant opportunity across those three franchises. We have $4 billion in revenue in capital markets and $1 billion in profit. We have a $500 million P&L in our wealth franchise, and we have another opportunity to do something similar in City National. So growing those franchises is really our core focus right now. But once we digest HSBC and we rebuild that capital base, then we'll
You'll come first and tell us.
We'll come first to tell you, exactly, yeah.
Dave, I want to finish on housing. I have to say, I'll speak for Lisa and me.
Yeah.
When rates went from 0 to 5, when we saw rate hiking cycles in places like Canada, the UK, and even Australia, we were both thinking about what on earth is going to happen to housing markets? Right. Where does that leave the banks? I was thinking about that with regards to Canada as well. What is happening?
So there has been a payment shock to Canadians, and The difference between Canada and the U.S. is we don't have a 30-year fixed mortgage. We usually have 4 or 5-year terms. So we have a lot of variable rate mortgages at the same time. 20% of our book roughly is variable rate mortgage. So you've seen a payment shock to about 30% of Canadians right now, in the tune of 20 to 25% increase a month, $400 or $500 a month increase. So that's been challenging for Canadians. What it does is it slows the economy much more quickly. Unlike the U.S., where there is no payment shock really unless you break your mortgage or sell your house. So the U.S. economy struggled to slow the consumer. The Canadian economy has slowed the consumer quite significantly, and we've seen that in the credit card business. People have a mortgage, people have a variable rate mortgage, credit card spend is off. Canadians are handling that payment shock well, so you're not seeing that migrate to default, but you're seeing the Canadian economy slow much more quickly to the point that we already have a quarter of negative GDP under our belt. We're looking at probably another negative quarter of GDP. We'll technically be in a soft landing recession early this year. So Canada's slowing more quickly. Inflation's still a little bit sticky, around just above 3%, but there's still 70% of that book is going to reprice over the next 2 to 3 years, and 15% this year, 25% next year. So unless we get rates down, there's more payment shock coming, but consumers are handling it.
That's one to watch. Dave, it's good to see you.
Yeah, it's great to see you. Thank you for inviting me.
Dave Mackay of the Royal Bank of Canada, live from Davos, Switzerland. This is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park. And that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
geopolitical tensions are on the rise. We are seeing signs of fragmentation.
When we have an escalation of these geopolitical risks and the deterioration of the geopolitical situation, that could have a very negative impact on the global economy.
The tensions that are carrying over from last year are still there. Obviously, the war in the Middle East is a big preoccupation, and concerns that will spread, although it seems manageable so far.
We're in Cold War II, could get to be a hotter Cold War II than it was, and that's very destabilizing.
Markets do a poor job of pricing in geopolitical risk until the triggering event occurs.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance on day 2 of the World Economic Forum. Alongside Lisa Abramowitz, I'm Jonathan Ferro, together for the week with Anne-Marie Hordern. Topic of conversation number 1 on the agenda. I said it in the last hour. If you have an American accent, you will be asked about this man, Donald Trump.
The Trump election, we all looked around and thought about putting in hedges.
I mean, I hate to predict anything he's going to do because the whole problem is he's completely unpredictable. But, you know, there's no appetite for that.
When we look at the likely policies, there may be some serious concerns.
It's, of course, a great concern. You know, we've been there before. We've survived it.
We are all concerned about it because the United States is the largest economy, but we have to be extremely attentive and anticipate, just as we do with inflation.
This has absolutely dominated conversations now for the last 2 hours on this program and the last 2 days at this forum. Lisa, that question's not going away anytime soon. That question, that conversation, behind closed doors, off the record, lively. When you start to ask people on panels at the World Economic Forum or in conversations on this studio, at this set, they don't want to talk about it too much.
They don't want to talk about it. I don't know exactly how much fear there is if you're not necessarily a global player that's looking for cooperation with the United States. From a business perspective, it seems like people are taking it more in stride. When it comes to just general uncertainty, not so much. And when it comes to international partners, a whole lot of concern about a real lack of cooperation.
And part of that is because they haven't prepared. They had 4 years to prepare for potential Trump's return. They know what the playbook and what his policies are, and he's not shy about advocating for them right now. If he is to be reelected, there's a good sense of what he plans to do.
This hour, just an absolutely fantastic lineup, Lisa. We need to talk about it. We'll catch up with the Dutch Prime Minister, Mark Rutte of the Netherlands. We'll also be speaking to the Foreign Secretary, Mr. David Cameron. Really difficult time with 2 wars ongoing right now, one in Ukraine and another in Gaza.
Yeah, and we're also later going to be speaking with Qualcomm CEO about the business environment in a very split world. But right now, we're going to be speaking with the Bank of Israel governor, which to me is a fascinating position at a time of such conflict, at a time where it's so hard to really piece out where the income is going to be coming from in an economy that's mired in war.
Let's start that conversation with Amir Yaron, the Bank of Israel governor. Governor, good afternoon.
Good afternoon.
It's good to see you. It's a delicate situation that you're in, so let's talk about it a little bit. Early October, your world changed. Can you tell me what it's like now, what's changed for you as a governor overseeing a wartime economy?
First of all, when the war started, the first thing we focused on was financial stability. And indeed, we put up a $30 billion selling of reserves, a $15 billion of swap, making sure the markets function. We all know what happens when market starts being in a negative dynamics. And indeed, we achieved that. The markets settled down after the shekel did depreciate, but there was enough confidence. There was some stabilization vis-a-vis the north, and the shekel actually went from 386 all the way down to 3.6. It's now at 3.79, but other markets function as well. We were primarily focused on that, and that's why we didn't touch the interest rates, and we made that message very clear. We lowered interest rate in our last meetings because we felt the markets have stabilized, and we saw inflation decelerating. Indeed, we just saw the CPI. Our target is between 1% and 3%, and it just happened to land on 3%. And so we lowered the rate. It's still restrictive, but we think that was necessary and needed given where we were, given a war, given all the financing. But going forward, as the committee said, it's going to be very cautious, very moderate, depending on how farther inflation decelerate, and how economic activity and the whole uncertainty around the world develops.
This is obviously a shock across several dimensions, but just to sit on inflation just for a little bit, you talked about the FX channel there. I'm with you. I think we all were. In the immediate aftermath, we're thinking about whether this would develop into an inflationary shock for the economy. What are your thoughts now on the trajectory for inflation? What's the outlook look like?
I think initially we saw the negative demand shock outweigh the negative supply shock, which is primarily in the construction industry, where about a third of the industry is from the West Bank and they're not in. That could affect inflation down the road in a half a year from now, where, you know, prices might come back up, and then rentals, some in agriculture, but overall the negative demand shock overweighed, and indeed it put inflation into the target faster than we initially anticipated. Prior to the war, we were on a path of a super softish landing. We were growing at 3.4% in 23, probably slightly above 3 in 24, and inflation was going to come down into the target anyway. Now we anticipate a 2% growth in 23 and 24. If everything is according to our scenario, which is basically military, primarily focused in the South, intensities will go down somewhere around the first quarter. In that scenario, it's that 2%, and then resuming back to Israel, potential growth of around 4-5% in 25. That's in terms of growth. The big challenge is the fiscal side. The fiscal, the war is costing us directly, and this is give or take about 10% of GDP and another 2% in sort of lost revenue. I call that the temporary hump of the war. The real, and we can, growth will take care of that in terms of what it will do to debt to GDP. The other side is the permanent component increase in spending on military, in the more expensive debt, and the revitalization of the South. That's about another 1%, and we were able to compress it, at least for now, for 1%. And what I want to point out is this week there was a new national budget, and the government went through, you know, in a pretty short time, through making significant steps to offset that 1% increase. And that puts us probably on a trajectory of stabilizing debt to GDP at around 66-67% in the next coming years.
We talked to a lot of officials, the Federal Reserve, ECB, and they talk about economic projections, and we talk about the varying degrees of angst around trying to hike rates into a recession if you see inflation picking up, or cutting rates at a time where inflation's not coming down. You have a uniquely difficult situation. How much certainty do you have around economic projections that are made at a time where there's still hundreds of thousands of people serving and are not able to fill their jobs, where you have tourists who are not coming to Israel and we don't know when they're going to come back? All of these types of existential questions hanging over that outlook. So
the scenario that I outlay and the numbers that I've given are obviously around an analysis and of a model, and these models have usually large uncertainty around them. Now expand that by a mile, and of course, if there is a North Border event, that that means the numbers are very, very different. But you have to basically analyze. We know what's going on in terms of the different segments of the market. We saw actually huge recovery towards November. For example, credit card usage dropped to about 70% when the war started. It's over 100% right now. We saw once missile stops, and many families were in the house and the education system was not on. That meant many people were not working. That has come back.
I am wondering, and you look at all the cross-country flows, how much flows from other Middle Eastern countries have resumed at a time when there's a real fear of a widening out in the war? Is there still the same kind of international commerce that can feed the economy in a supportive way?
So I would say, first of all, as you know, the high-tech sector in Israel is very, very important for our economy. the companies obviously are still working. You said obviously there are some workers that are in reserve, but generally they're working. I think the big issue is going forward, not to lose a cohort of new young seeds, the ones that are well known and have revenues will continue to do that. And, hopefully the new relationships that we're just beginning to establish, whether it's with the UAE, et cetera, those will continue. And, the challenge will be to bring a day after in which there is a mechanism, there is security to Israel, security to people in Gaza that actually, and some prosperity there. And, that is obviously a challenge. It's not really in my hands. But I think if you look at Israel's, talent, it's there in terms of the high tech. There's a lot of demand for, home security, economics now. And so I'm pretty confident those things that we're monitoring will be there. Obviously, this is a big shock, and we are continuously monitoring all these developments, as you say, segment by segments, and all this analysis is predicated on the best information we have right now.
It is a big shock, and you're a wartime central banker. How are you planning for the impact or potentially your response if this was to expand, either to the northern border or potentially even more skirmishes outside the Red Sea and et cetera?
So as I mentioned, we first took our main course of action was to make sure there's financial stability. Once that settled down, we went back to the interest rate tool, and even there I said it's going to be moderate, it's going to be cautious, it's going to be partly a function of inflation, economic activity, and further developments even on the fiscal side, and of course on the geopolitical side. If things develop, we will need to readjust our assessment and maybe go back into a mode of focusing more on the financial stability.
Do you feel like you're constrained to some extent if this war did spread and it increased the shock to the Israeli economy? Do you feel like you are constrained to your ability to reduce interest rates from here?
I think either way, the process would have probably been a slow process.
Yep.
I don't think interest rate, not just in Israel, I think around the globe, when this cycle is over, they will be in a higher zone than they were before. So the path here is not going to be at a rate of hikes that we did upward. It's going to be slow. It's going to be moderate. And it's probably going to stabilize at a higher real interest rates, and which means also somewhat higher nominal interest rates. So I don't think we are constrained, except the fact that we are going to be cautious anyway, and we are going to be on the lookout for any financial issues and developments that we look. And as I mentioned, we don't often mention fiscal policy in our forward guidance, but we did. And as I mentioned, I think there were significant steps at least to offset the permanent component, which means our debt to GDP should stabilize and not diverge, and I view that as a very important statement to the markets.
Governor, we appreciate your time today.
Thank you very much
for being with us. Thank you, sir. Amir Yaron, the Governor of the Bank of Israel. Coming up shortly on this program, Chuck Robbins, the Chair and CEO of Cisco. From Davos, Switzerland, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news,
Trump is leading by a long shot.
insightful interviews,
and at the end of the day, that's what the American people want.
and the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in New Hampshire, only on Bloomberg.
Ever since we started this journey of bringing the U.S. chips and the EU Chips Act to place, it was all about building resilient supply chains. Everything digital runs on semiconductors, and through COVID, we saw the fragility of our supply chains. Because of that, we said we need a balanced supply chain for the world, and that's what we're off to do, is to rebuild the Americas and the European supply chain for semiconductors. So, hey, we're all better off, right?
Pat Gausinger, the Intel CEO. You bump into some folks here at Davos, Switzerland that are just constantly, consistently upbeat, regardless of the time of the morning. Pat Gausinger's one of those, isn't he?
He was incredibly upbeat. I was just curious whether his scarf was a QR code. And
I thought the same thing.
So I actually tried it. I took my phone and I tried it. It was not a QR code.
No, but he did say he was going to try and transform it into one. Or something like that.
Something to work on. Artificial intelligence.
We'll move on from that. Don't worry about that. Let's turn to the price action just briefly. Yesterday, a down day on the S&P 500. Today, a down morning so far in New York. Equity futures negative by 0.4%. Yields climbing just a little bit higher by a couple of basis points, 4.08%. At the turn of the year, it was all about rate cut talk. Can we start in March? Can we deliver 6? The pushback over the last couple of days has been overwhelming.
Yeah, although Steve Chiavarone put it well to me, it's not a matter of people betting on 6 rate cuts. It's people betting on both a soft landing where you don't get as many rate cuts and a recession where you get a lot more rate cuts. And that's sort of the divergence that you're seeing expressed in 6 rate cuts. What we've heard here is a whole lot of optimism. And I think that's the reason why the not as many rate cuts is really the story that gets the greatest attention.
Well, let's talk about whether that optimism is backed up by the facts, the outlook for global growth and what it means for Cisco. Chuck Robbins, the chair and CEO of Cisco, joins us right now. Chuck, good afternoon.
Hello, how are you?
Good to see you, buddy. Great to catch up. As always, let's get straight into it. Engines for growth. Ken Rogoff of Harvard sat in your chair at the start of the week, and he said he's not sure where growth is going to come from. That's an economist. You're running a business. Where's the growth coming from?
That's the difference between someone who runs a business, right, and an economist. We've talked about AI all week long. Yep. It's a big opportunity for us, and I think that you'll just continue to see new opportunities emerge, things we don't even understand yet, and applications that we haven't seen that are going to take advantage of what's going on in AI over the next 6, 12, 18, 24 months. Cybersecurity is an incredible area of investment for our customers, particularly as generative AI helps the bad people be worse people. And make them better at what they do, and we have to really come together as an industry and work hard to protect our customers. So cybersecurity is a big one. I think all of our customers continue down this journey of thinking through how their applications are architected and where they reside. Are they in the cloud? Are they in the private cloud, public cloud? Which public cloud? Or am I consuming them as a SaaS application? Hybrid work is still in place. There's still a lot of positive out there.
How many years have you been coming to Davos?
This is my 11th.
Okay, so it's been 11 years.
Yeah.
This Davos feels a little bit different, like people are actually just trying to get a lot of deals done and try to figure out exactly what to lock in. Do you get that feeling too?
Well, I think somebody asked me earlier about whether this felt like a normal Davos, and I think it seems busier, first of all, this year. And I do think there's a lot more tangible business discussion, I think, going on than you might see normally. But there's also a lot more to talk about with all the complexity going on. You've got elections, you've got the Middle East situation, you've got Ukraine, you've got are we going to cut rates? You've got AI. I mean, it just goes on and on and on and on. There's just so much to talk about.
What's going to affect your business most? I mean, are you expanding more in certain regions to avoid some of the conflicts that you keep seeing? Or are you basically just sort of keeping an eye on all of this and then chugging forward with continuing to try to hire the best cybersecurity people and move forward with all of the different programs that you've been working on?
Yeah, I would say that we're investing in areas where we do see growth. We're investing a lot in AI. We're investing in cybersecurity, the same areas that I talked about earlier.
In which regions?
In which regions? It's pretty. I'd say it's pretty well balanced. The AI specialists tend to get hired where we have engineering hubs, so that's first and foremost. But we've also, because of what we saw in the pandemic, I think every company's been diversifying geographically relative to their supply chains, so that, as we've talked about before, no one ever designed a supply chain expecting an entire country to shut down. So we had to make some changes to that, and we continue to work through those kinds of things.
You've been going through a big transition for quite a while, going towards software, towards recurring revenue. We've been talking about this for years together.
We have.
Is that transition complete now? Are you comfortable with where you're at?
We've made a ton of progress. When we get the Splunk acquisition completed, we'll surpass $20 billion in software sales as a company, which puts us somewhere in the top 6, 7, I don't know, something like that. So, but there's still more to do. There's still more software assets we can build organically, probably some inorganic stuff we can do. But at the same time, with the AI explosion, we're a significant recipient of the infrastructure benefit underneath the GPUs in both the web scale as well as ultimately in the enterprise. So our hardware business, which in some cases has subscriptions associated with it, in some cases do not, we think that both of them can grow over the next few years.
This is a tough question to answer, but do you think investors have fully internalized your view on where things are going and your message?
I think they've internalized the message. I think they're just looking for, one of the things that we've talked about is that this transition to software should give us more predictability and less volatility. And we've seen that come into play, but we still probably have a little bit too much. And so we've been rewarded for what we've accomplished. And I think as we continue to do that, and we continue to deliver, you'll see that in the future.
You know, from being here for a couple of days, everyone wants to be a part of the AI story. What surprised us, and I speak for myself, what surprised me last year is how quickly it became real. It wasn't just a story that companies were selling, it was something they were monetizing, and the growth was exponential in some cases. Yeah. NVIDIA, a great example of that. Can you walk us through on where you're seeing actual real tangible growth right now off the back of what's developing?
Yeah, I've actually told my team you're not allowed to espouse about AI unless you follow it with a tangible way that we're implementing whatever you were talking about, because there's so much noise in the system. Look, I think if we're building the infrastructure that's going to support underpinning all the AI networks. So that's happening today. We're running pilots right now with web scale players. We're working on a lot of design around future integrated stacks that we're going to take to the enterprise to help them do it. Secondly, we're looking at how we can deliver better customer experience for our customers by leveraging Gen AI, which every company is or should be doing. We're building security assistance, as an example, to help customers navigate all the security tools you have and actually make sense of a lot of it more rapidly. We're doing the same in collaboration. We're transcribing meetings, and so there's a lot of stuff that's going on right now. But I do think some of the greatest applications, we have no idea what they are yet.
Which is something definitely that's been a theme.
This thing is early. It's super early.
One thing that's early maybe is that HPE is coming for you more aggressively. They bought Juniper Networks last week, and they said that they're going to be able to compete more directly with you. So what's your response?
We love good competition.
What's your way? What's your way of gaining some of the market share in a highly competitive market?
Look, I think that we have competed with both HPE and Juniper in the past, so I don't know that it changes a lot for how we think about competing with them, to be honest.
Chuck, it's good to see you.
Good to see you.
Thank you. Thanks. Diplomatic. Very careful about answering that question.
Yeah, I didn't say.
Chuck Robbins of Cisco, CEO, on AI and the real tangible areas of growth we're actually seeing in businesses. To try and I think Chuck's right, to try and draw a line between the noise, which is everyone's just trying to say AI, and like I'm a part of that story, and the actual tangible things that are happening, materializing in front of our eyes. Two important things to look at.
especially not only on the benefits but also the risks. And I do feel that in some of the conversations. And we're not just talking about misinformation, but I was struck by this one line that we've heard repeatedly. I know that you've heard it, I've heard it as well. Financial disruption in new types of ways that really could become problematic that people aren't really thinking about. These are some of the things that people are trying to hash out in much more real terms here.
Confronting an era of misinformation, maybe. Never mind the good things we might do with this new technology. I think there's a big focus here as well on some of the bad things. In the next 30 minutes, absolute must-watch television. Mark Rutte, the Prime Minister of the Netherlands, and David Cameron, the Foreign Secretary of the United Kingdom, all coming up in the next 30 minutes. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Economic data in America just seconds away. Going into it, the scores look like this on the S&P 500 and in the bond market. Equity futures negative by 0.44%. Yields are higher by a single basis point at 4.07%. As we wait for retail sales to break and the conversation continues over how many rate cuts we'll get in 2024. With the economic data, let's get to Mike McKee. Good morning, Mike.
Good morning, guys. We are looking at a good month for retail sales, it appears. I'll get the breakdown in just a second, but right now we see headline retail sales up 0.6%. I'll be waiting for the revisions to that. Retail sales always heavily revised. Ex-autos up 0.4%, and ex-autos and gas up 0.6, which is good because we know gas prices fell, so that's still a lot. The retail sales control group, which is what goes into GDP, up 0.8. That after an initially reported 0.4 in the month of November, so that is double what was what we saw last month, and it's 4 times what was expected. Quickly looking at import prices, they were flat on the month after a decline in November, and ex-petroleum flat on the month. So no inflation pressures coming in from those. And one other data point I want to give you before we get to the breakdowns of this stuff is mortgage applications. We haven't paid a lot of attention to that for quite some time for obvious reasons. They were up 10.4% last week after 9.9% the week before. So we've seen a little backup in rates, and we're seeing some results in the mortgage market.
Mike McKee, we're seeing some moves in financial markets, so let's round them up. Let's go through equities, bonds, and foreign exchange. March rate cut. What March rate cut? And I think we said this after the payrolls report a few Fridays ago. So let's look at the equity market first together. Equity futures near session lows on the S&P 500, pulling back. In the bond market, yields are higher, much higher. If you break up the yield curve, 2-year, 10-year, 30-year, go to the policy-sensitive front end of the yield curve, up 14 basis points on the 2-year off the back of that hotter-than-expected retail sales print. 436 on 2s, on 10s, 411. In foreign exchange, dollar stronger, euro weaker, 108.56 off the back of this. Lisa, that data endorsing Governor Waller's view of the world in the past day or so.
The strength is not going to allow them to cut rates as quickly as people are pricing in, and I think that that's what this data seems to suggest, and that seems to be what the market is hearing, albeit on the margins right now we are seeing still a 58% chance of a Fed rate cut in March, but it is coming down, edging lower as we go through this.
And Mike McKee, you've had a few extra seconds to chew over the number. Do they look as good as they look on the surface?
They do. All those pretty coats you guys are wearing in Davos, I know you picked up probably in December. Clothing and clothing accessory stores were up 1.5%. That's the leader during the month. So you did your part for the U.S. economy. Gasoline stations down 1.3%. No surprise there. Gasoline prices continue to fall and take away from inflation. We saw motor vehicles up 1.1%, but even without the motor vehicle component, retail sales were strong. Food services up 0.6, so that is also good. Building materials up 0.4. I keep saying also good. Pretty much all of these are good except for health and personal care stores down 1.4%. Department stores were up 3%. That is a strong number after there were expectations that maybe people weren't buying as many goods at the holiday time. Non-store retailers, your Amazons, etc., up 1.5%. But food service and drinking places were flat on the month. No increase there. So I'm not sure. Maybe you guys bought coats instead of drinks during the month.
Mike, I just want to finish up because we were talking about what are the most important indicators to really be watching. Was it the jobless claims that are going to be the sort of leading light, or is it going to be some of these retail sales, the consumer continuing to spend? Do you hear more economists paying more attention to indicators like this that are coming in much stronger than many people expected?
Well, there's been a lot of talk about whether the economy is slowing down or picking up, and this fits into the picking up camp. And so we'll see whether that starts to get incorporated in people's views of GDP for the quarter and for the future. We should get an Atlanta Fed GDP Now number out reasonably soon this morning, and it should go up. I want to point out that the retail sales control group I had said was up 0.4 in November. The revision is up 0.5. So even stronger sales in November and strong sales in December give everybody something to look at. Now, yesterday, Chris Waller made a lot of news. news by saying that 6 rate cuts were ridiculous, and this is kind of supporting that view at this point. The Fed is not going to be cutting rates if the economy is this strong. So we'll see next week when we get to PCE numbers. They'll add in services to these good spending numbers, and we'll see how overall strong the U.S. consumer is.
Mike McKee, thank you, sir. Mike McKee on a hot retail sales report. Let's turn to the price action again, Lisa. We'll go to 3 boards and work through it together. Equities going into the opening bell about 55 minutes from now. Equities pulling back off the back of better than expected retail sales. Equity futures negative by 0.5% on the S&P 500. We can turn to the bond market. Yields are higher on a 10-year by 4 basis points, 4.1% on a 10-year. On a 2-year at the moment, higher by a lot more than that. Double digits, up by 11 basis points, Bramo. Your 2-year, 4.33.
And this just sort of confirms the steady grind that we've seen as we get better than expected data and as growth has surprised the upside. If we get a true belief in soft landing, that probably also means a true belief that we're not going to get the rate cuts that we're going to expect. But is this inflationary? And that was something that Mike has talked about. When can we stop thinking about immaculate disinflation if we start to see some of the inflationary inputs pick up as well?
Really pleased to say, Lisa, we can continue the conversation here in Davos, Switzerland. Cristiano Amon, the CEO of Qualcomm, joins us around the table. Cristiano, how are you, sir?
Very good.
Good to catch up with you. Let's start here with the business. I want to get straight to it. The smartphone business. What's happening with Apple over the last 12 months? Their core piece of hardware seems to have gone ex-growth. Have we reached that point of saturation for smartphone sales, do you think?
Well, that's a good question. Maybe I'll take a step back. You know, the phone market is a big market, but, you know, it's a fully penetrated market. And I think we go into cycles. I think we did see in 2023, particularly correction. I think we have, to the pandemic, we had a lot of demand. But, you know, we had some last earnings call. I think the market is returning to stability. We're cautiously optimistic. So I think we have the normal rate of the market, which is a replacement rate market. But this Gen AI transition could create a new upgrade cycle, and then all of a sudden we have a lot of growth again, and we'll see.
Let's put some sort of some tangibles around this. When do you see the smartphone market returning to growth? How long will it be before we get there?
It's very hard to make a prediction, especially because you know, you look at the market today, and you know, the market used to be much bigger, even when you think about prior to the pandemic. We're not calling the market number just yet in 2024, but we know it's smaller than it was to be. I think people looking at the current macroeconomic environment, they kind of decide when they're going to buy a new phone. However, the growth vector, it's really related to new functionality that it's going to compel you to buy a new phone. And we just, like today or tomorrow, I think Samsung is launching at Impact a new device, going to talking about Galaxy S24, some of the things you can do with Gen AI on the phone. And as we get to the transition, I hope everybody wants to buy a new phone. We're going to have growth again.
And we'll be able to just go like this, and the person that we want to see is right going to be over there. I'm curious, from your point of view, how concerned you are about, say, Apple creating its own chips, creating its own hardware. And we've seen this, and they basically had some issues with it. They prolonged their replacement chips. But how much does that worry you?
Well, look, Apple has always had their own processor on the iPhones. I think our relationship with Apple is on the modem. We provide to them the chips to make their cell phone connect with the cellular waves and make sure you're connected. That's our job. They have been focused on trying to develop their own chip, but recently we just renewed our agreement with them. I think we have a new agreement with them. It covers out to 26. And we'll see. I think right now we're just focused on being a good supplier for the next 3 years, and I'm going to give you my same answer. As long as cellular remains important, I think there's going to be a role for Qualcomm.
You've been pretty safe when it comes to some of the tit-for-tat between Beijing and Washington, but how are you looking at navigating that going forward, given what we've seen other companies deal with?
Look, we've been fortunate that some of the things what we do today, we're not in the data center, we have not been impacted by any of the restrictions. And in one way, as the peak of tensions, I think, between the two countries, I will say that our business actually with China actually increased as we diversify, you know, our company not only into phones but into PCs and cars and industrial. We expanded our relationships with China. Here's my simple answer, I think, to that question. any company that has a leading technology product and is a product that becomes very important for the digital transformation of many industries, such as automotive and others, you're going to have a big business in China. It's just a function of GDP. I think we have been so far in a stable place. We have to monitor the situation like every other company. And, I will continue to believe, and that's what I had said, at the end of the day, strong commercial relationships between American enterprises and our Chinese counterparts will be one of the things that could bring stability to the relationship.
Does that monitoring get more challenging if we were to see a former President Trump win back the White House next year?
Look, we're just focused on our technology, and we want to have markets that we can sell our technology. I think at the end of the day, one important thing to understand is certain technologies are globally interconnected. So you're going to have customers in different locations. You have customers in Europe and Japan. They will have a business in China as well, and you want to be a global supplier to them.
I can see the Qualcomm team just around the corner, very happy with that response, that you didn't take the bait and talk about the former president. Cristiano, I want to talk about the direction of travel in the global economy. For a chip maker, just for the industry, do you think we're close to the point where they have to pick a country, have to choose a side? We're either going to supply China or we're supplying Europe and America. How close are we to that moment?
Look, I don't think we are right now at this point in the industries that we serve. And it's one of those things that, if it changes, I think companies have to adapt. We have seen that some industries had to face that. And you have some industries that's kind of the reality for different reasons, whether it's a cloud company or a social media company, and et cetera. We have been not at this pace, so it's something that we're going to have to worry about it in the future.
What industry do you think is going to be the biggest area of growth for you?
We are very pleased what's happening with automotive. We're now working with virtually every car company. The car is becoming a new computing space, and our job is to provide the digital part, and I think sometimes they go alongside electrification. That's an exciting. It's going to build revenue for Qualcomm over time. The other one that was really happy about it, and it's new to us, we're entering the PC space. We just built now the fastest processor for any laptop, and we think that could be a great opportunity for us.
Okay, I have to ask this. As we step back and sort of reflect on this AI-infused Davos, are we even going to have laptops, or are they basically going to be headsets that we put on and we go like this and our words kind of show up? I mean, how far are we going away from the previous models of normal existence?
Look, it's interesting. It's a great question. I remember when laptops appear, people thought that the desktop will go away, and then when phones appear, people said the computer's going to go away. Yeah. And when glasses appear, you think the phone's going to go away. I think the reality is your phone's going to be still with you. Your laptop's going to be still with you, but they're going to become much better, and they're going to become more useful, and you're going to get more out of them. And I think that's going to be the great opportunity of Gen AI in those devices.
Cristiano, appreciate the answer. Thank you, sir.
Thank you. Happy to be here.
It's good to see you. Cristiano, I'm on there, the Qualcomm CEO. What's this? Words come up when you do this?
Yeah.
What's that?
I mean, don't you see people wearing headsets and they go like this, and they can
they sort of get lost because they've got the virtual reality headset.
Exactly. I'm excited to see what they can do.
Now I understand. I just didn't know what.
$4,000 headset that Apple's launching.
Well, it could be the future, and maybe it'll cook dinner.
Serious face. Coming up on the programme, next guest, Mark Rutte, the Prime Minister of the Netherlands. That conversation just around the corner shortly after this commercial break. Just to touch base on the price action following a better-than-expected retail sales report out of the United States. Equity futures on the S&P 500 negative here by 0.55%. In the bond market, we look like this. 2-year, 10-year, 30-year. The 2-year yield is a bit higher off the back of that story. Bramo up 10 basis points on a 2-year, up 4 on a 10-year.
So we had talked about the potential loss of some sort of volatility. It seems to be coming back just a bit. I will say there does seem to be a feeling in the soft landing. One key question is how much has been priced in. Steve Tannenbaum of Golden Tree Asset Management was saying he thinks about half of it has been walked back. There's another half that still has to go.
You know, for special guests, we don't take commercial breaks, and one of those special guests is a good friend of ours, Mark Rutte, the Prime Minister of the Netherlands. Netherlands. He's jumped into the chair. Prime Minister, it's good to see you again.
Good to be here.
It's fantastic to catch up. We've got a lot to talk about.
What a Davos it is.
Is that what it is?
Yeah.
I won't try and repeat that, okay? Prime Minister, you're in a different position now. I've caught up with you over the years at this forum several times. You're now overseeing a caretaker government. We can talk about your future down the road in just a moment. There's a big focus on Geert Wilders at the moment. Can you talk to me about that man and help our audience understand who he is, the man that you've known for a long time, and what we should all know about?
Well, I'm not sure that's up to me, because you could interview him, and I think he would love to do that.
I don't see him here.
No, the point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration. And clearly, he got the upper hand in the election result. Now, we are famous for having to form coalitions. It takes a long time to do that. So that could still take another couple of months. So we have to see how long that takes. In the meantime, I'm there. But I'm absolutely convinced that on the fundamentals, our outlook to the rest of the world, support for Ukraine, membership to the EU, nothing will change.
You don't think these political changes are a threat to the European project?
No, I don't think so. Because for the Netherlands, yes, we want a strong nation state, but we also need, as one of the biggest exporting countries in the world, we need that membership of the internal market, NATO, the UN, because our safety, both in the economic sense, but also in a literal sense now that Ukraine at this moment is being attacked by Russia, is crucial.
Let's get to NATO. ECB President, odd character in her position to be commenting on the former president, but has commented on the former president, Donald Trump, said that Donald Trump was a threat to some European interests, including NATO. I'd like to talk about NATO with you. We all would. It's interesting to me how the Europeans constantly frame this as America not helping us, the former president not helping us. Can you help us all understand how European countries and governments have been helping themselves? What's happened with defense spending in the last 4 years? Have they put NATO in a better place?
And this was exactly Trump's main issue, that we were not spending enough. And he was right. He was right, because America is about 50% of NATO economy. They were at that moment, when he was president, spending about 75% of the NATO budget, and the rest of NATO was only doing 25%. So he was completely right in forcing us to live up to the 2% commitment. So we invested another 5 billion, which brought us to the 20 billion, which is almost 2%. We are still not exactly there, but almost. And many other countries have done the same. So I always thought that he had a genuine argument here. And by the way, for the US, to be in NATO is also in their strategic direct interest. If Russia would gain access to this part of the world, it would also be a threat for the US. So NATO is not just a project from history, never repeat the mistakes of the Second World War. It is also about security now, today, also for the US.
And this is why you've told your colleagues when Trump was president that you shouldn't criticize him. He is right when it comes to some of these multilateral, multinational organizations that more should be done. We need to look inside. No. But you're potentially going to be working with him again if you get the top job as Secretary General of NATO, which rumor mill has it that it's going to you, and Trump was to come back. How would you handle him? Because people say to me that you were a Trump whisperer of sorts.
No, no. What I always said is we have not voted in the US. I'm a Dutch citizen. I cannot vote in the United States. So we have to dance with whoever is on the dance floor. And in the end, for the whole of NATO territory, it is crucial that you have amicable personal relations with the other people. And in the end, in the US, it is not only the president making all the policies. There's also the very forceful and powerful Senate Foreign Relations Committee. The House is involved, and there is a strong transatlantic tradition in the US. And I always felt again that Trump was right on this issue of paying up to our commitments.
But is that also a confirmation that you are taking that job at NATO?
I'm not commenting, because I said something about it in October, and I've decided to end it there. So,
but it will be in the next few months. I mean, NATO's celebrating their 75th anniversary. It's a big year.
Yes, this is a big year for NATO, because in the Washington summit is the 75-year summit, where Jens Stoltenberg will preside as NATO Secretary General. No, I said something about my own future in October, and I leave it there, and I'm not going to add to what I said at that moment.
Although I would like to just sort of build on this idea that Trump has been front and center at this conference. What do you think people have wrong when they talk about some of their fears? Because we've heard this again and again, that a lot of people are very concerned about Trump 2.0, and you don't sound that concerned.
Well, of course, first of all, I cannot vote in the US. Secondly, I do not agree with everything Biden or Trump are doing, and I don't have to because I don't live in the US. But in the end, for me, from the Netherlands, we are, after the United Kingdom, the most transatlantic country in Europe. We are one of the biggest trading nations in the world. So that relationship with the US for us is crucial, and that means that whoever is president, being fairly elected in that country, we will work with. And it doesn't make sense to start commenting before the election is taking place, oh, if this happens or that happens. Well, then you should become a US citizen. Then you should try to get yourself on the ballot.
All right, which is
not possible if you're not born in the US.
Because you've checked. No, but I'm curious about, the reason why people are thinking about this now is because we're thinking about, okay, how stable is the landscape that Davos has come to celebrate in some ways, which is this globalization and this idea.
Here, the issue is this, that we are always talking about globalization, and we need globalization. We need the multilateral system. But also the strong nation state. And what I think in Davos for too many years we have done too much is celebrating the multilateral world order, forgetting about the necessity that you also need strong nation states. And you need the one and the other. It is not neither or, you need both at the same time. Because for example, my country, what is my task? Strong economy and making sure that the Netherlands is safe. To have a strong economy and make sure the Netherlands is safe, we need the EU, we need NATO, etc. But it's in the national interest of the Netherlands. So we need both. And sometimes this almost gathering of the world elite discussing multilateralism as something in its own right is not right. It has to be connected and grounded in the nation state. That's my belief.
Prime Minister, I know you've only got 90 seconds left with us, so I want to finish on this. You've been at the forefront, I think, of this conversation where others have been lacking in Europe, getting Europe to look at itself about what Europe needs to do. The European model, for many, including us sitting here, feels broken. To rely on America for defense, for China for economic growth, for Russia for energy. It feels like in the last 10 years we've seen a real setback, a reality check. As you step back from the Netherlands, from your current role as Prime Minister, what's the new growth model look like? What does the new model actually look like?
EU. The internal market is the biggest internal market in world history, as NATO is the strongest defense alliance in world history. So the EU is successful. Don't tell each other or try to convince each other that the EU is broken. It is not. Yes, there are many issues we have to solve. But take, for example, our dependency on Russian gas. We have been able in just 18 months basically to deleverage that dependency on Russia in terms of our gas supply. And in many other issues the same. And when it comes to our collective defense, we have stepped up in terms of defense spending. Most NATO countries also being member of the EU. We have now Finland in the EU. Sweden will join as soon as possible. So I'm not that pessimistic. No, I wouldn't buy that story.
Prime Minister, it's good to see you.
Good to see you.
Your perspective. It's great to catch up, sir, as always.
Time.
Margaretha there, the Prime Minister of the Netherlands. Anne-Marie trying to press him there about the former President, Donald Trump. He wasn't biting, but one thing that the former Prime Minister, Margaretha, the current Prime Minister, soon-to-be former Prime Minister, has said often, that the former President was right to criticise NATO and to push the Europeans to spend more on defence.
Yeah, absolutely. And what has been more of a shock for a lot of these European countries that they weren't at 2%, and there is a war right now on the European soil. I know that's been a huge issue for the UK Defence Minister, who said at the Warsaw Security Forum, what is it going to take for these European nations to increase their defence spending when there is actually a war on our doorstep?
We've got a lot to discuss this afternoon. One more fantastic conversation still to come with David Cameron, the British Foreign Secretary. I want to check out the price action just briefly. 3 boards for you. Start with equities. We'll go to bonds, then to foreign exchange, going into the opening bell in about 38 minutes' time. Equity futures on the S&P 500, negative here by 0.6%. On the NASDAQ, we're negative by 0.9%. On the Russell, the small caps, down by 1.5.
I'm laughing.
In the bond market, I'm trying to carry on.
You're trying to carry on. It's complete chaos over
30 year. I've got the Dutch Prime Minister shaking my hand while I talk bonds. The Foreign Secretary of the United Kingdom's jumping in the chair. I'll carry on. In the bond market, yields higher by 4 basis points. On a 10-year, 4.1%. Your opening bell is about 37 minutes away. Now things can settle down. We're still live. I'm not sure David Cameron knew that. The British Foreign Secretary joins us right now. How are you, sir?
I'm good. I hope I didn't get in your shot.
No. Just rattling through bond markets. Insignificant stuff. Don't worry about it.
That was the reason for it, but it didn't seem to work.
Let's get away from the markets and talk about your world.
Yeah.
It's a really, really delicate time. And what we're seeing in the down commerce in the Red Sea?
Well, they're doing it because they're backed by Iran and they've had weapons provided to Iran. And, you know, between the 19th of November and last weekend, they'd made 26 attacks. We'd given warning after warning, but we hadn't taken action. We have now taken action. We've demonstrated we're prepared to back our words and warnings with actions, and I believe that will make a difference.
You were part of the strikes that took place more recently with the United States. You remember about 10 years ago that you had to shelve strikes in Syria because of a vote in Parliament. Just as a principle, is that something you think should be happening when the UK takes military decisions?
If you're taking urgent and immediate action, I think it's perfectly acceptable for the government to act. And of course, you've got to weigh up the operational security with consulting Parliament. But the warnings were given in Parliament. Parliamentarians were perfectly aware of what could well happen. And now there's been a statement in Parliament, and that's entirely right. Of course, there was the situation with Syria many years ago. I'd point also, we have taken action with Americans and others to get rid of the ISIL threat that was there in Syria and Iraq, and that was a very successful intervention. But clearly, look, this is about freedom of navigation. We want to have the freedom of navigation. It's vital not just for our economy, but for every economy in the world, including some of the poorest countries. And you can't have a situation...
Including China, just to jump in. And it's interesting to me that this could have huge consequences for trade in China. And yet China's not a part of what took place in the last week. Why aren't they getting involved?
Well, China did sign up to the UN Security Council resolution that condemned the Houthi attacks and said that nations had a right to self-defense. And so I think that is progress. But yes, if you're asking, is Britain a country that is prepared to stand up and work with allies and take action if we have the capabilities and if we can help? Yes, we are, because we think it's important that you don't always leave America to act alone.
Will the conflict continue in the Red Sea until there's a ceasefire in Gaza?
Well, obviously, you've got to look at all of these different things that are happening in the Middle East. I think the important thing is to try and deal with each of them. I don't think it was possible to go on allowing these attacks to continue in the Red Sea. But at the same time, yes, of course we want to work towards a resolution of the situation in Gaza. I've been very clear that should involve an immediate humanitarian pause. We need to get aid in. We need to get hostages out. That requires a pause. And of course, we've talked about a sustainable ceasefire because you've got to get rid of Hamas and its ability to rain down terror on Israel. But the best outcome would be moving from that pause to a sustainable ceasefire without a return to hostilities, without more destruction. But for that to happen, a number of things would have to take place. We'd have to see the Hamas leadership come out of Gaza. You'd have to see the hostage situation being resolved and resolved very rapidly. You'd have to make sure that Hamas was no longer capable of doing rocket and terrorist attacks onto Israel. You'd have to start working out who's going to govern Gaza and how, a new Palestinian authority. But I think that should be the ambition. That should be the plan, moving from an immediate cessation to deal with hostages, which is a pause, and moving from that into a sustainable ceasefire.
Whether it's Hamas, whether it's Lebanese Hezbollah, whether it's Houthis, all of these roads lead to Tehran. Where is going to be the Western response to Iran?
Well, we have delivered very tough messages to Iran, including I had a discussion with the Foreign Minister last week. And obviously there's a number of sanctions and other measures already in place. But I think it's absolutely vital that we send a very clear and unequivocal message to Iran that its behavior in supporting these proxies, whether it's Hamas or Hezbollah or indeed the Iranian armed groups in Iraq and Syria, its behavior is unacceptable. And we need to make sure that there will be consequences for this behavior in terms of sanctions.
Say, actually striking a leadership like Qasem Soleimani?
No, look, I think what we need to look at is all the tools that we have in the toolbox. And obviously, we have been using, for instance, sanctions against a number of people in Iran, and we need to look at how we can step that up if this behavior continues.
There's a real question here as the leadership, and you're saying that there needs to be pretty strong measures taken, this needs to get resolved, etc. And then you see protests flooding the streets of London with all these people coming out to support Hamas, to support, yes, the Palestinian people, but also to really protest some of these actions. How does that complicate your job if you're losing a lot of the popular support?
Well, I wouldn't. Look, these protests, look, a lot of people feel very strongly about what's happening in Gaza, and I completely understand that because we have seen a huge loss of life. We've seen a lot of destruction. I support Israel's right to act in self-defense. I understand why they have to get rid of Hamas, but we all want to see fewer civilian casualties, less destruction. As I've said, I think there is a pathway to try and deal with this. We have a right to protest in our country. People are free to come out onto the streets and make their views known, but we have to work out what's the right thing to do to bring this to a conclusion. So it's often tempting in foreign policy to say the easy thing, let's just have a ceasefire that's comprehensive right now, but it won't work unless you deal with the problem of Hamas. And actually the thing that so many of those protesters want, which I want, which is a two-state solution where you have Israel and Palestine side by side, you'll never get that if Hamas are still in Gaza launching rockets capable of carrying out terrorist attacks. A two-state solution requires the bringing to the end of that situation.
I know you have to go. I want to squeeze in another question. Don't let me down, because I always say that British politicians have much thicker skin than American politicians do. So forgive the bluntness of this question. There is a 20-point gap between the Conservative Party and Labour. If we were to have an election right now, polls indicate your party would get absolutely trounced. What do you think is behind that? Do you think it's poor policy preferences or incompetence?
I remember sitting probably in a chair like this in 2013, 14, when I was Prime Minister. We were way behind in the polls. Everyone had written us off. They were saying, you know, start thinking about packing your bags. And we won that 2015 election. And we won it because we had a strong team with a clear plan. And that's what we've got now. We've got a very capable Prime Minister with a very strong team and a clear plan on how you deal with everything from illegal migration to growing the economy to sorting out some of these problems in terms of international security we've been discussing about. I didn't just come back into this government to come to great foreign gatherings like this and talk about foreign affairs, vital though that is. I came back as a full member of the team because I really believe in this team.
Well, it's good to see you, sir, and we're looking forward to talking to you more through the year ahead. David Cameron, thank you.
Thanks.
Thank you very much. The UK Foreign Secretary. David's going to exit left now, and we're going to carry on doing markets just to fill the screen as he goes past us. So let's do that right now because he's got to run. So let's get to the equity market on the S&P 500. On the S&P 500, we are negative by 0.6%. The opening bell about 29 minutes away. We have to round things up by talking about the last 30 minutes or so. We've talked about the reality check that's taken place for global leaders, given what's taken place, not just in the global economy, but also in the foreign policy hotspots at the moment for international security, Ukraine and Gaza. Big takeaway the last 30 minutes.
I think what Mark Rota said about how you have to have strong nations in order to have internationalism, and the sort of increasing tension that this concept of just all leaning into some sort of multilateralism isn't going to work is something very apparent. But the companies are having the opposite tone, which is we got to still do our business. And our business, you have to look at the GDP of countries around this world, and that's where you're going to do your business, period, full stop. And you got to work with what you got.
Anne-Marie?
The internal perspective from the Dutch Prime Minister about looking in the mirror, and also the fact that Trump was correct on a number of these issues, and I'll say it again, Europe has had 4 years to sort itself out and prepare.
Plenty of fantastic conversations still to come from Davos, Switzerland. That does it for day 2. On day 3, Morgan Stanley's Ted Pick, Brian Moynihan at Bank of America, and a whole lot more. From the team at Davos, Switzerland, this was Bloomberg Surveillance. This is Bloomberg.
From the hillsides of Davos to New York City. For our viewers worldwide, a very good morning. I'm Manus Crenny in for Jonathan Farrow. These equity markets are reviewing the narrative from central bankers, from Waller, Lagarde, and Knott. It's all about a new rates dynamic. Back up the truck in rates and review your equity allocation. The countdown to the open, it starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up on the show today, we just had the retail sales coming in hot, 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 sending equity futures lower and treasury yields higher. The global central bankers of the world push back. We begin with a big issue, curbing your rate enthusiasm.
The market's a little optimistic.
A little too optimistic. Too optimistic, really.
On the rate cutting cycle.
And the start of the timing of rate cuts.
The majority of the G10 central banks in terms of interest rate cuts.
There has been some repricing.
The expectation is that the Fed will cut rates at some point. The question is when and by how much.
The 6 rate cuts, that's a pipe dream if we have a soft landing.
You're seeing a mixed bag in the overall data.
The economy is actually doing great.
The economy has been strong enough so we can keep rates stable for a while.
Central banks are going to remain vigilant for longer.
They are still concerned about how sustainable the recent disinflationary trend that we've seen. So what we're going to see is more of an elongated pause.
The Fed is good at waiting and watching and lagging.
The Fed is not going to rush to start implementing those rate cuts.
Wait, lag, roll. More data in this system today. Mike McKee joins me now with it. So we've had central bank narratives and a little bit more data. Mike, good morning.
Good morning, Menace. And again, it's the same question we've been asking for days. What is it going to take the markets off of the idea of so many rate cuts? Chris Waller, the Fed governor, pushing back strongly yesterday. Here's what he had to say.
Becoming more confident that we are within striking distance of achieving a sustainable level of 2% PCE inflation. When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully. I see no reason to move as quickly or cut as rapidly as in the past.
Well, the markets took that under advisement and did back off a little bit. Then we got the strong retail sales report today. And right now, when you look at what's being priced for December, they're no longer pricing in 6 to 8 rate cuts. They're pricing in 5.7 rate cuts. So not a big change out of the markets in terms of the futures pricing at this point. And again, we ask, what is it going to take to get them on the same page as the Fed? Certainly, Waller got a help from the retail sales numbers as they come in extraordinarily strong for the month of December, up 0.6%, double the November number. And look at retail control. This is data that goes into basically the GDP numbers for consumer spending, up 0.8% after 0.5 in November. Import prices flat, import prices ex oil flat. So no inflation aspect from imports during the month, and it does suggest that we're still seeing a strong economy. Atlanta Fed GDP now will come out later today. We'll see what they have to say. But the forecast consensus for next week, about 1.5% for fourth quarter GDP, Manus. That's going to go up. Whether that brings down the idea of further Fed rate cuts remains to be seen. You know, for March, we're still pricing in about a 60% chance of a rate cut.
Yeah, although that has dropped from over 80%. Mike, thank you very much for the update there on the retail sales and the Fed speak. Let's talk about the narrative from central bankers around the world with Invesco's Matt Brill, Ashok Bhatia, Alf Neuberger, Berman. So I listened to Waller yesterday, and for once the bond market actually did react. You then add in these other voices, Lagarde, along with not from the ECB. So we've got a trifecta of voices of central bank about moving carefully, pull back your timing. Finally, do you think this is getting through to the short end of the rates market, and will it build on that narrative? Let's take it to you, first of all, in terms of the narrative. Ashok, good morning.
Morning. We think it can back up a little bit from here, but probably not a lot. And there's really two big things going on, I think. The first is the endpoint for where policy rates are priced seems to us pretty fair and appropriate. And that's, a 3% funds rate, a 2% ECB rate, 18 to 24 months from now. And that seems like a reasonable endpoint, and that will anchor a lot of the front end. But the second element is, the market is really debating whether an easing cycle is going to be due to inflation normalization. So as inflation comes down, central banks adjust policy rates to keep real rates steady, or whether we're going to get significant economic weakness. And, but easing is a part of either solution. It's really just the pacing of it. And as we get more economic data over the coming months, we think we will see some softer growth. So this back and forth in rates, it's not going going to go away, but these levels to us seem relatively fair.
I mean, you just look at the retail sales, and we'll come back to those in a moment. Again, blistering hot retail sales with a SLOOS report that's under pressure. So it's hard to choose your poison that you're going to put down. Matt, let me bring it to you. Do you think sort of job done for the Fed for now? Are we finally coming to heel? 6 are off the table, slow dissipation. The Fed will get us back towards the mean where the options market is. The options market's coalescing around 3 cuts. It's only everybody else in the media, apparently, that's just rampant with 6.
Yeah, good morning. I think that the Fed did what they had to do, which is, just continue to talk this down. We think March is off the table, but, what really matters is the direction. And I completely agree with what was just said, is that, we're on the right path to call it 3.5%, I guess, by the end of this year. Maybe a little higher than that, but we're going to get there, early 2025. And so whether they cut in March, April, or March or May, it doesn't matter so much. But the path is coming, and we think it's going to happen because the data is going to be there. It's not because the economy is going to fall apart, but because the deflationary forces continue to be prevalent, and that's going to continue to flow through. So the Fed's going to talk it down all they want, but month after month, you're going to continue to see that inflation get more to their normalized levels.
Okay, so then this takes us to how do you want to position? And if I take it back to you, Ashok, you said a year ago, underweight duration, but here you are. Overweight bias is appropriate, but I get the sense that you want to be more tactically, have the tactical ability to trade these markets. You say an overweight bias is appropriate, while tactically shorter when the market appears to get over-optimistic on cuts. And guess what? Debt sustainability. We haven't talked about that for a while. So is this about ultimately long duration, but with tactical layovers of shorts?
Yeah, I break it into a couple of key areas. I think for short-term interest rates, so 5-year and in maturities, there'll be a lot of noise back and forth, but we're investing in these points, characterize us as overweight investments in these areas, because as cash rates come down, people should extend duration, lock in these high yields. I think on the longer rates, it's a little trickier. This cycle is reintroducing term premium, curve premium, inflation premiums, and the valuation there, we think we're a little bit below fair value. And then the third real quick point is we think still, this is a pretty strong week for issuance and financials. There's a lot of things going on in the European credit markets. So, fixed income is still offering, investors, 5 to, mid-single digit or mid-single digit, high single digit returns, depending on your risk profile. So it's a little more nuanced this year than last year, but I think there's still a fair amount to do to lock in these yields effectively.
Okay, hold those thoughts. Ashok, we'll come back to you, Matt, in just a moment. It's all about the yield. It's almost like a song for you at the end of last year's charts. Joining me now to look under the hood at some of the stocks that are on the move, Katie Greifeld is with me. Katie, what have we got?
Let's kick off with Tesla, just like we did yesterday. The headlines around Tesla this morning, Tesla slashing Model Y prices in the European markets. That's according to Investors Business Daily. And that's on top of what we talked about yesterday with CEO Elon Musk pressuring the board for a bigger stock award. You add it together, Tesla down over 2% right now. I want to highlight AMD. It closed at its highest level since November 2021 yesterday. It's climbing a little bit pre-market right now. That's after a round of price target upgrades from the sell side, including Barclays, which sees AI as a primary driver of growth. Definitely heard that one before. And Apple. The Supreme Court refused to hear Apple's appeal in an antitrust suit. As a result, the company is opening up its U.S. App Store to outside payment options. That's dragging down the stock a little bit this morning, down about 1% before the bell.
Okay, some interesting moves. Deja vu, Tesla on the move, and first off the block with Katie. Coming up on the show, fresh insight on the U.S. consumer.
Consumers throughout the last year found a good balance to satisfy their spending priorities at the same time dealing with elevated prices and inflation.
U.S. retail sales providing just the latest read for the consumer. What it could all mean for markets as rates review the sales. This is Bloomberg.
professional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. New time starts Monday.
So consumers throughout the last year found a good balance to satisfy their spending priorities at the same time dealing with elevated prices and inflation. When we just look at the United States, we expect a story of continued prioritization. Consumers just being mindful of their spending because borrowing costs are still high. But relief might be waiting in the wings with the Fed as if and when they cut rates, which there are a lot of people who expect that.
MasterCard CEO there weighing in on consumer spending, and the trend is continuing. Look at the numbers this morning. Sales are beating the estimates, blowing the doors off. A resilient consumer, the data, spending on clothing, department store shopping, and food services. And that strength is likely to mean a delay in the rate cuts and the timing, endorsing Fed Governor Waller's take. That's still robust economic activity doesn't present a reason to move quickly on the rate cuts, and that was the narrative just 24 hours ago, reinforced in the hills of Davos by Lagarde. Katie Greifield, were you out there helping the retail sales? I was. I did my bit for America.
You and me both, Manus, and I don't know if Fed governors are allowed to take victory laps, but I would imagine that Chris Waller may be feeling vindicated this morning. To get specific on the numbers here, retail sales unadjusted for inflation rose by 0.6% last month. That is the strongest pace in 3 months, and as you mentioned, it was a pretty broad-based advance. 9 of 13 categories posted increases, and that was led by clothing, department stores, e-commerce, and motor vehicle sales. And good news, gas station sales fell for a third straight month as, of course, pump prices continue to fall. So that U.S. consumer remains strong, Manus, and you take a look at the market reaction right now, it's fairly consistent. You have equity futures down and you have bond yields higher, especially at the front end of the curve. You take a look at the 2-year Treasury yield right now, it's higher by about 11 to 12 basis points. That's in addition to yesterday's advance. And that gets back to what Mike McKee was telling us just a couple of minutes ago, that as the data continues to roll in hot, that case for earlier rate cuts, it just continues to weaken. We've heard as much from Fed officials in recent weeks, and that is absolutely the conversation that's happening across asset classes this morning.
Victory tastes so sweet, doesn't it, Katie? Even though I'm sure central bankers wouldn't possibly say that that's how they feel. Katie Greifield on the retail sales. My guests this morning are Matt Brill and Ashok Bhatia. Gentlemen, let me bring you the latest hot off the press quote from Ellen Zentner over at Morgan Stanley. The beat on the control retail sales, Governor Waller's recent remarks, the economy is strong enough that the Fed can remain patient in determining the next move. We expect the Fed, the first cut Fed in the Fed funds is in June, while noting the risk toward an earlier start in May versus market pricing of March. Look, we're going to spend the next 3 months yapping about this until we actually get 25 basis points of a cut, and we'll know whether it's inflation or a crumbling economy that provokes it. But to this narrative, this is not going to be a pandemic-style rate-cutting cycle. This is not going to be a GFC-style rate-cutting cycle. And maybe that's where the bond market has got ahead of itself. So to both of you, Matt, bring it to you first of all. You're all about the yield. A back up in the truck of yield is an immediate buy for you? It's just an incremental layering of buying?
Yeah, I think so. I think last year, if you had asked me if a backup at yields was a buying opportunity, I would have said yes, but we would have done it, with alligator arms, would have been very hard to do. Now we feel a lot more convicted on where I was saying earlier, where the eventual path is going for rates. So I think there's a bit of a ceiling out the curve, just given the inflows that are coming, and that anytime we see a backup at all, yes, it's absolutely a buying opportunity.
Now, Ashok, you're a man after my own heart. Tell me about the yield to maturity. Don't give me the coupon. I can clip coupons all my life, but I got to get the yield to maturity. I understand what that is. As you look across the curve, where is, let's say, the best yield to maturity in your view right now? If we do coalesce around 3 to 4 cuts as opposed to 6.
I think if you're looking, a bit more of a conservative investor, it's agency mortgages and, 5-year types of financial securities, banks and money center banks and that. And if you're willing, able, want to take a little bit more risk, it's things like U.S. and European high yield, a little bit up in quality there, and emerging markets. And those can hit a little bit of the higher single-digit return yield to maturities.
Matt, for you, it is about the rally. We've had a magnificent rally in investment grade and in high yield. This morning, you got a little bit of a shake on that. And I just wonder, is it the same narrative for you, which is within IG, when you get a shake in the tree and you get a back up in yield and you get the opportunity to step into IG in the first instance, which is what everybody's telling me that you've got to be long off. So you must welcome these mini shudders.
Yeah, I think we do. I mean, I think, we call it get another bite at the apple, and we've gotten a few additional bites here. And I think, when we back up, we see more inflows versus last year we backed up, we saw outflows. So the market has turned in that regard. And I think that sets us up for a nice little rally here. We're hashtagging coupon and more in 24. We do think you're going to get a coupon plus year. It's just going to be not a straight line. The rally was so vicious to end last year. We're up still to date about 10% from where we were mid-October in the corporate debt market. So overall, quite a bit of rally last year, stole from this year. But going forward, anytime you get a backup, it's a good opportunity. We're seeing institutional accounts buying more than they did last year. But the new guest to the party is retail. Retail did not buy much at all last year, and they are really stepping forward this year.
Okay, so they're stepping into the breach. There's two other moments that happened in the past couple of hours. One was a jock shock for CPI in the United Kingdom. I think that's the tail that's wagging the global bond dog. But also Christine Lagarde. She was cautious. She's setting the summer table. Let's just listen in.
I would say it's likely too, but I have to be reserved because we are also saying that we are data dependent and that there is still a level of uncertainty and some indicators that are not anchored at the level where we would like to see them.
So a prudent Christine Lagarde, a shuddering CPI from the UK. To both of you, this is the worst nightmare for every central banker, which is you get this inflation jolt in the CPI, Matt. How much more at risk is the US of that kind of a shock that the UK had today?
Well, I think the path won't be completely straightforward. So, there's likely to be a hiccup along the way. So, in that regard, I'm a little bit concerned that you could have a little bit of a shock here in one of these inflationary reports. But really the trend, the data just keeps showing us in 8 different places that it's coming down. So, we think the biggest area to watch is the wage market, the employment market, and it's much more imbalanced than it was in 2023. And in that regard, we feel pretty good.
Ashok, to you, obviously every central banker is trying to hold on to the narrative. Where is the risk here for the US in that narrative?
Yeah, I don't think the risk is really on the inflation prints. I think one key thing about this year is inflation volatility, at least in the first half of this year, is going to go down. It's getting to be much more predictable. I think you're seeing that in the prints that we've been getting have been much, they've been bunching up closer to consensus. Mm-hmm. So there is not a lot of, I think, deviation from where inflation's going to go the first half and it's falling. It's growth and how quickly the labor market weakens.
Okay, the jolt will be growth, not the inflation. I'd say Bailey in Threadneedle Street is probably pondering those various outcomes for himself. Matt, thank you very much. Matt Brill and Ashok Bhatia, my guests this morning on the rates moves. Coming up, your morning calls a little bit later. We've got John Hancock's Emily Rowland helping me to make sense of the case for large cap US equities. That conversation still ahead on the opening bell. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The new Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Let's get your morning calls from the analyst recommendation. What impact are they having? Morgan Stanley downgrades Mutel to equal weight, seeing limited growth drivers on the horizon. Next up, UBS downgrades Ford to neutral, expecting a challenging year due to industry-related headwinds. And finally, JP Morgan downgrades Morgan Stanley to neutral, slaying your own, saying the shares are fairly valued with few catalysts for this year. Coming up, John Hancock's Emily Rowland unveils her outlook for the markets for 2024. Does she agree with the banking calls? We'll put those questions to her in just a moment. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Counting down to the equity market open as the short end of the yield curve in the United States of America re-rates on the number, the size, and the trajectory of rate cuts. So the equity market has got to review the momentum that was imbued in the November-December rally. Equities are lower, they're clapping, we like that. There is the opening bell. It's going to be an initial drift for equities on the downside. We're going to get some of the regional banks. We'll get into those numbers in just a moment. SPOOs are lower, NASDAQ is lower as rates re-rate higher at the short end of the curve. We're up by 11 basis points. That has an impact on the growth to value trajectory. The dollar put on a mighty show yesterday, the biggest rally since March. The euro is down. Christine Lagarde says, wait until the summer. We'll go to the Côte d'Azur, and then you may have a rate cut. So euro-dollar drifts by 0.1%. Yields, as you can see, settling around the 4% level. My last two guests said, when it richens up, that's when we will step ladder in. And crude drops by 1.9% as, again, the narrative around the oil market is more about poorer than estimated Chinese growth data, along with disinflation or deflation coming out of China at the pace that we haven't seen since 1999. We're in a risk-off mood, and it's taking everybody down with them. Okay, those are your markets. Two stocks to watch, JetBlue and Spirit Airlines. I've yet to travel with them, and a federal judge is blocking the $3.8 billion merger to antitrust concerns. Katie Greifield is with me. This is a blow to this airline sector.
It is a blow. Spirit and JetBlue forced apart, like you mentioned, that U.S. District Judge siding with the federal government, saying that the merger would harm cost-conscious travelers and violate antitrust laws. JetBlue and Spirit, of course, argue that consolidation is the only way for smaller airlines to really compete in this industry. They're evaluating next steps, but what we know for now is that Spirit shares are in an absolute tailspin. You can see them down 15% pre-market. That's in addition to yesterday's 47% plunge. That was a record loss there. JetBlue faring a little bit better. It is down this morning, but it actually rallied by almost 5% yesterday, and that probably comes back to this deal's price tag. $3.8 billion for JetBlue to take over Spirit. Shareholders clearly thought that was a bit pricey, Manis. Now, it remains to be seen what happens next. These companies can either appeal the ruling or abandon the deal altogether, but consensus says that challenging the judge's decision here would be a long shot, especially when you consider that the merger agreement is set to expire in about 6 months' time. Okay, well, certainly it's a different landscape here to that in Europe when consolidation was allowed during periods of deep distress. Katie, thank you very much. Let's turn our page to financials. We've got regional bank earnings hitting the wire. We're underway. Citizens Financial, US Bancorp are both reporting notable declines in the fourth quarter profit. Shonali Basak broadens the reach beyond the top tier of Wall Street to go regional. Shonali.
Manis, when you look at the regional banking system, the likes of Citizens and US Bancorp are going to be hit by FDIC charges tied to those bank failures last year that will hurt a little more for a mid-sized bank than it would perhaps for some of the biggest. Now, you are seeing the stock movement. Interesting, the parting ways here, US Bancorp and Citizens getting a little bit of a lift here. You have to remember that the KBW Bank Index has still sold off quite meaningfully into this year. You have Schwab hitting some pains, down more than 6%. Just remarkable. It had missed estimates on net new assets as well as retail brokerage accounts. Remember, Schwab is also coming off a tough year, though it is a behemoth in its own sector. A lot of competition among brokerages, and as we know, it got into a lot of banking services that made this year difficult. I would also say that while net interest income at these regional banks, the year's expectations are kind of muted here, particularly when you look at Citizens and US Bancorp. One bright note here is that charge-off rates are not rising also meaningfully. So kind of calm credit quality here is what investors have to look forward to after such steep sell-offs, really leaving the KBW Bank Index in between where it was at its 52-week low right after that banking crisis and the 52-week high yet to be seen. That is well past $100, and you're looking at a bank index down by 92 at the moment.
Yeah, well, certainly they take a big chunk out of the net new assets, dropping 48% to $66.3 billion. Shonali, thank you very much for wrapping up the regional banks report cards this morning. Let's turn our attention to the telecom sector. Verizon, they're writing down the value of its business services division by nearly $6 billion, a sign of declining sales. Isabel Lee can give us the detail. That is a chunky write-down.
Very chunky indeed, Manis, and it's $5.8 billion to be exact, and that's one of the largest write-downs in the company's history. So that's as the unit continues to grapple unsustainable with falling results. So the company attributed the non-cash goodwill impairment charge to secular declines and macroeconomic pressures. And after this charge, the company will be ending 2023 with $1.7 billion. So why has it come to this? So Verizon, as many know, is really a legacy company that's best known for its wireline operations. But this segment has since declined ever since its mobile services boomed. And in fact, Bloomberg Intelligence said Verizon's wireline business is expecting a muted 2024. For now, the consumer unit is the biggest revenue driver for Verizon. And shares last year ended 2023 lower by 4%, and right now it's a touch lower by 0.6%, Manas.
Isabel, thank you very much. Switch over to the automakers. Day two, Tesla extending its monthly decline to roughly $90 billion after announcing a second round of price cuts just in as many days, this time in Europe. Ed Ludlow is with me from San Francisco. 2 days in a row you show up within 24 hours with bad news on Tesla. What are you doing?
It's not bad news from me, Manis, but actually in the last 30 seconds, Tesla's declines have accelerated beyond 3%. The news or catalyst is price cuts in Europe, specifically for the Model Y. Mid-single digits across a number of markets as followed. Prices in Germany down on the Model Y between 4.2 and 9.1%, 5.7 to 6.7% in France, 4.3 to 7.7 in the Netherlands, and up to 7.1% in Norway. It's been an interesting 12 months because at times the market has viewed Tesla's ability to cut prices and open new pockets of demand, that lever, as a real positive because operationally and on the bottom line, they are streaks ahead of the legacy OEMs and other EV makers. They have some wiggle room on the bottom line to do that, though the other side of the coin is that there is a debate about whether these price cuts as a need to open new pockets of demand are indicative that the demand has gone away. Remember as well that Tesla plans to pause production at its Berlin plant in the final week of January, first couple of days of February, because of the impact from the Red Sea. And a senior Tesla source told me over the weekend that just like everyone else, Tesla's action in the context of the Red Sea was to divert shipments of key components on new routes. It's not that they won't end up in Berlin, it's just going to take them longer. So that, and also the debate around Elon Musk's new compensation deal, asking for greater voting rights, adding some downward pressure to this stock, down 3%. Manas.
Ed, thank you very much. Ed Ludlow there with the very latest on Tesla. John Hancock's Emily Rowland weighs in on the earnings season so far. This is what she says. Not a great start to the earnings season this past week. We still have a long way to go. The bar for companies to beat is much lower than where it was just several months ago. Joins me now. Emily, good to see you this morning. I mean, I look at the performance in the earnings season so far, and this is what we've got for you. What we have is, if you missed on your earnings, you really are taking a smack. Now, this is also, the analysts have lowered their expectations in terms of earnings growth. From what you've seen so far in this earnings season, it's still early innings. What do you make of it?
Yeah, so again, still early innings, but the bar was lowered significantly. Analysts had been penciling in positive 8% earnings growth for the S&P 500 at the start of last quarter, and now it's negative 1%. So that's good news, but as you mentioned, companies that are missing are definitely being punished. One of the key narratives that we're watching closely is the fact that top-line growth or revenue growth for the S&P 500, again, it's early, coming in around 2.8%. So that's below the 5- and 10-year average. So what we have to remember here is that revenue growth was awesome during the height of inflation because companies could pass those higher prices along to the end consumer. So we saw explosive sales growth for companies. That's now normalizing, but we're also seeing profit margins getting compressed. That's coming in below 5- and 10-year averages. So what companies are dealing with now, of course, is a much higher cost of capital as rates have gone up at the same time that revenue growth is shrinking. So those margins are really getting challenged here. And the key for companies from here is who can manage that best in an environment where it's going to become a lot more difficult.
Well, which sectors can manage that back if things do get a little bit more difficult? Everybody's telling me it's a disinflation story, not the US falling off a cliff. Well, China is exporting deflation or disinflation, but you know, who can handle it better? Because Tesla obviously has got a whole other narrative going on, but talk me through your view.
Yeah, sure. So we continue to emphasize the quality factor. So these are companies with great balance sheets. Think about ones that don't need to tap the capital markets in order to grow. So low interest burdens, lots of cash, great return on equity. Now the poster child for high quality is the U.S. tech sector. We still like tech. We're not downgrading it, but as we all know, it was up 57% last year on 5% earnings growth. 5% earnings growth was of the best we've seen for any sector across the globe, but still so much multiple expansion now. In fact, the S&P 500 growth index is now trading at a 44% premium to its 20-year average. So we want to think about owning other sectors that also score high on quality. Healthcare is one of those for us, and it's now trading at a 10% discount to the broad market. We think we're going to see some big changes in consumer behavior as people stop maybe buying all the stuff they want to buy, but they're still going to do the things they need to do, like go to the doctor and seek medical care and engage in utilities. Another one of our favorite sectors, as we may see this rotation play out into more defensive parts of the market that, again, score high on those quality metrics. Of course, the retail sales report this morning, not quite telling that story yet.
No, it's not. You know, thank goodness we all still get sick. We'll still need the doctor. We might not need a new iPhone, but we're still going to need the doctor. That is resigningly reassuring. On the retail sales, I mean, it really was a strong, strong report. How exposed to retail do you want to be? Because delinquencies are rising. I'm going to talk a little bit more about that in a while. But what exposure do you want to have to the consumer? I mean, it's my favorite phrase of 2023, the hedonism of the U.S. consumer. Don't ever bet against it.
That's right. And here's what I wouldn't bet against. As long as people have a job, they're going to continue to spend. Some of the data we've seen suggests there's some weakening in the labor market. You know, things like the quit rate are back down to pre-pandemic levels. Job openings continue to normalize. You look at some of the survey data, like ISM Services last week, and the employment components plunging. But that's not really matching up to the hard data we're looking at. Initial jobless claims coming in near the lowest levels of 2023. With the non-farm payrolls report, I'm running out of ways to describe how it's so much stronger than expectations. So as the labor market continues to show this resilience, it's hard to see consumers pulling back from spending. But again, we would not be emphasizing the consumer discretionary sector. We are going to be contending with the higher cost of capital, not just businesses, but consumers, with 25% credit card interest rates, elevated auto loans, of course, mortgage rates still very, very elevated relative to history. So I do think consumers will start to see those headwinds. Things like loan forbearance are no longer a tailwind. Excess savings have been spent down. Wouldn't bet against the consumer in a period of a strong labor market, but it's hard to see what that catalyst is for a meaningful acceleration from here.
Emily, hold those thoughts. We're going to return to some of them in just a moment, sticking with us for this morning. Coming up, JP Morgan unveiling plans to add to its headcount.
The company has the returns and has the firepower to continue investing through the cycles. And that is what it really allows us to continue, regardless of the economic environment, to continue growing.
Plus, the regional bank earnings get underway after a mixed quarter. America's biggest lenders. That conversation on Bloomberg.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
In a couple of drugstores, even in my area, which is not the tourist area in Washington, D.C. It's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem. And, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we're all part of an organization that's coming together that says if we can put our camera feed together and tell that person has been in our store and their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades?
I will tell you, it started at razor blades because that's such a high-ticket item, but, it's a lot of cosmetics, but really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world starting Monday, every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Continue investing through the cycles, and that is what it really allows us to continue, regardless of the economic environment, to continue growing. We have, at the moment, we are employing, at the end of this year, around 320,000 people. So the number of people that we employ has been growing and not shrinking. So I think that where we see opportunities and we can help our clients, for sure, we will focus on that. When I look at our plans, we will increase our staff this year, for sure.
JP Morgan President Daniel Pinto, they're planning to add to their overall headcount, seeing numerous opportunities and projecting plenty of growth for 2024 after their record earnings. Meanwhile, you've got the regional banks. They're rolling in across the tape. U.S. Bancorp and Citizens top out the estimates, but it's taking a hit to the net interest income. Shanali Basak is back with us again. Shanali, the differential here, how do I draw the line between the two?
Between Citizens and the regional banks. Okay, yes. So it is an interesting moment here. You're not seeing the stock react significantly, Manis, here. You are seeing just a little bit of a pop, and you have to remember that these banks have sold off meaningfully, and we're looking at two of the larger super regional banks. And when we go through this earnings season, remember, we have many more banks to go. It's going to give you a bigger picture of what the landscape looks like. Remember, these two banks, because they're the larger of the super regionals, also took FDIC charges that investors are happy to get out of the way because it did weigh on the ability to return capital to shareholders, let alone put new money to work. And so even though for these two banks, U.S. Bancorp and Citizens in particular, you did have both average loans and leases and deposits falling a little bit below estimates, you do have the worst of the banking crisis behind you, particularly for banks like those that are less exposed to more battered parts of the economy, let's say. We are still watching credit quality. We are still watching things like consumer loans and auto loans. Schwab, as you saw, is a largely different story, because if you are among the biggest of big banks or biggest of big brokerages here, and you are not meeting the mark, you are seeing a nearly 6% sell-off here. And you're coming into this conversation talking about JP Morgan. All of these firms are a long way away of the 21% returns that JP Morgan is inking today. So investors need a story to help these banks get back to par when you think about what their pre-banking tumult highs would be. You can call it a crisis or not, but many of these firms have never recovered.
And in many ways, we're waiting to hear what Sergio Monti at UBS will deliver in terms of new financial targets. He's coming to eat their lunch in terms of allocation to banks. Shanali, thank you very much. Shanali Basak there with the Super Regionals. Emily Rowland is with us to talk equities. Emily, you say the financial sector is an extreme example of taking down the earnings growth in the back quarter of 2024. A lot of it was to do with FDIC. We're actually seeing the lines printed on FDIC now. Are we past the worst? Do you think it's still going to be an issue with us for 2024? Or how do you look at financials? Have we passed the worst in that respect?
Yeah, I mean, we're looking at it via the lens of the comps from here. So whereas Q4 of 2023, we're seeing about negative 40% reported earnings growth. Again, a lot of that due to the charges to the FDIC around the regional bank issues. Now analysts are significantly upgrading their expectations for Q4 of 2024, penciling in over 20% earnings growth. And that's a trend that we're seeing across the S&P 500. So right now, while the bar is low, negative for this quarter, we're looking at analyst community penciling in 20% earnings growth for the S&P 500 in Q4 of 2024. Now, let's not forget that that's on top of almost 20 times forward earnings being priced into the market. So not only have you seen this incredible amount of multiple expansion, but you're also seeing really optimistic earnings growth baked into the denominator. So, you know, for us, it's really hard to see where that significant kind of breakout in stock prices can come without a significant acceleration in earnings growth from here, not only for financials, but for the broad market.
If we just step back for a moment, you know, with such a momentum in November and December, a recalibration in January, I'd imagine if I was sitting in your seat at the moment, you'd say, look, I'm quite happy with a little bit of truck backing here in the yields and in equity markets. It lets me reflect on where I do want to pick up dips. Is that how you're thinking at the moment? I mean, rather than being asphyxiated and fearful, you try and look for the opportunities of where did I miss the bus last year that I could maybe jump on board?
Yeah, that's exactly what it is right now. We do think that there are some opportunities in the market, again, to find things that are already trading at a discount. We're looking at areas like U.S. mid-cap equities, which are trading at the biggest discount to their large-cap counterparts since the late 1990s. We talked earlier about healthcare and utilities also offering some value, but it's not a surprise to see the markets taking a little bit of a breather here. You know, in November, we first started to see that big Fed pivot, inflation coming down, the Fed suggesting cuts. That was reiterated in December, and we've been calling that the great pivot party, and everybody was invited to it. No matter how much risk that you wanted to take in portfolios, you were rewarded. And now we're kind of feeling a bit of the hangover from that, or maybe it's the dry January that investors are trying out right now. Some of us have failed, or some have succeeded at that. But really what we're seeing today is just a little bit of a pause, and we're back into this kind of good news for the economy is bad news for the markets. I mean, you see the retail sales numbers this morning, industrial production coming in better, the labor market still holding in with strong data. That's causing this backup in rates that's been exacerbated by investors kind of recalibrating their expectations for how much we can see in cuts next year. So I think pretty normal here for markets to be taking a little bit of a breather. I think if the lagged impact of Fed tightening does not cause something to break, which is usually what happens in these late cycle environments, and markets can continue to chug along here. I just think it's optimistic to think we can get another year of 25+% returns.
Okay, well, they're certainly taking a hack to this NASDAQ this morning. The NASDAQ 100, NASDAQ 100 mini down 1.4%. SPOs are off by 0.7%. That's what you call an attack on tech. Katie, thank you very much with the very latest there. Coming up on the show, the market moving events you'll need to watch out for. That is your Trader's Diary up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Let's get you up to speed with your trading diary. This is what you need to watch for the rest of the week. Secretary Yellen discussing Bidenomics at the top of the hour. Then the Fed's beige book hits the tape at 2 p.m. Eastern. And on Thursday, there's another round of jobless claims and housing starts. Friday, it's the deadline for the U.S. government shutdown. And a look ahead to existing home sales. And the UMich Sentiment Survey. We'll also keep an eye on the inflation expectations in that survey. As you can see, Jonathan's in Davos. I'm here. That was Countdown to the Open. And this is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True, what the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
And good morning, I'm John Tucker, along with Molly Smith, fresh from, where did you go?
Well, first Antarctica and then Mexico.
Antarctica and Mexico.
And now to Bloomberg HQ.
And I was in Bayonne. The U.S. consumer not falling off a cliff. Well, not by any means. The investors still grappling with a possible reset of Fed rate cut expectations. And after running into Waller's wall of worry, more Fed speak today. We're going to hear later from the New York Fed President, John Williams. Good morning, everybody. This is Bloomberg Markets. Let's get an update on the markets right now. A reset, and to do that, here's Nathan Hager. Hi, Nate.
Well, hey, John. Well, the U.S. consumer might not have fallen off a cliff, but stocks are certainly taking a dive. It's one of those what's good for the economy is bad for market scenarios, with retail sales coming in at their strongest pace in 3 months in December. Now, markets are dialing back their expectations for rate cuts from the Fed even further. Tracy McMillian, head of global asset allocation strategy at Wells Fargo Investment Institute, says for now, the risk to the market is to the downside.
It's very likely that we could see a retrenchment back down to the 4,300 level on the S&P 500. We don't see, really much upside in the near term. At this point, there's only about 5% upside to the top end of our year-end target, which is the 5,000.
And we are watching markets move lower for risk assets. We check the markets for you all day long on Bloomberg. Right now, the S&P 500 is down 36 points, or 0.8%. 47.29 is the S&P level. The Dow Jones Industrial Average down 90 points, or about 0.25% at 37,269. The NASDAQ Composite sinking. It's down 1.5% now, down 221 points. 14,723. 8 of the 11 main industry groups are in the red, led lowest by communication services and information technology. Utilities, financials, and consumer staples are just barely in the green right now. 10-year Treasuries down 15 seconds. The yield 4.11%, a gain of about 6 basis points. The 2-year 4.35. That's 13 basis points higher. NYMEX crude's down 1.8%, down $1.29 at $71.10 per barrel. COMEX gold is down 0.8%, or $15.50 at $2,014.50 per ounce. The euro weaker against the dollar right now at 1.0856. The yen is at 148.38, and Bitcoin, that's down 1.9%, trading at 42,600. That's a Bloomberg Business Flash. Bloomberg Markets is on now with John Tucker and Molly Smith.
All right, Nate, thanks a lot. And let's get a look under the hood right now with stocks on the move, some of the companies to watch. Good morning to Bloomberg Equities reporter Nora Melinda. Let's start off with Schwab. At one point, we're kind of lumping that in with regional banks in terms of capital.
Yeah, I mean, Schwab, as we've been hearing from a plethora of banks at this point, Schwab is down, headed for its biggest plunge in 10 months. That's since March, after the firm reported a decline in net new assets in the fourth quarter as the brokerage navigated a tumultuous year where interest rates hiked, denting the firm's balance sheet.
Yikes. Looking at this story was the Schwab said that their net new assets were $66.3 billion. That's a 48% drop on the year. Oof.
Brutal. Massive. I mean, investors aren't really taking this well, as you can see. That stock is down as much as 7.2% in trading this morning. We did have an analyst from Wolfe, Stephen Chubak, say that he sees the quarter's revenue trends as soft, saying that it reinforces his view that the consensus is too high for 2024 to 2025. So it sounds like he kind of thinks that investors should be pulling in some of their bets on this company.
Have we heard from Schwab? I mean, what are they saying in response to this?
I mean, I think the CEO did say that through an uneven environment with shifting views on the trajectory of the U.S. economy, persistent geopolitical unrest, and a temporary disruption within the regional banking sector, our new trade-off value proposition continued to resonate with investors. So it sounds like they're taking a little bit of a different side than what the market is, how it's receiving it.
All right, let's move on to some of the airline stocks.
Yes.
Not a good day in airline world in terms of mergers and acquisitions or whatever they were calling it.
Right. It feels like we've been talking about airlines so much, especially with everything that happened with Boeing and, that panel flying off. But Spirit Airlines is in focus today. It's extending its losses after dropping as much as 61% yesterday, after a judge blocked its merger with JetBlue Airlines on antitrust grounds. The ruling also implies a reduced likelihood of a successful merger between other airlines such as Alaska Air and Hawaiian.
I'm curious, why would they, they're smart people, presumably there.
Which ones?
Well, yeah, I presume it here too. Why would they initiate the merger in the first place, knowing that the regulatory environment is what it is?
I think everyone's really been waiting for these M&A. We've been waiting for the return of mergers and acquisitions. That was something that investors have really been pleading for all through 2023. And as we are kind of seeing a return into 2024, this was a pretty big deal. I want to say it was about $3.8 billion for this deal specifically. So it is a little bit stressful to think that this is a rule that's being striked down. An analyst at Cohen actually said that he sees the ruling as a positive for JetBlue, as business at Spirit has turned negative ever since this deal was announced.
Yeah, we were writing in the story here now that the analysts from a couple of different brokerage firms saying that that Spirit now may face the prospect of a bankruptcy filing, that this is really do or die for Spirit, whereas JetBlue now, maybe we don't have to shell out about $4 billion, we'll be okay.
Right. So it sounds like Spirit is kind of taking the brunt of this hit right now, down as much as 21%.
All right, they really needed this deal. Let's move on. We did get some data today about, I don't know, was it mortgage
applications and home builder sentiment out 7 minutes ago.
I know, exactly, especially with you being in the eco space. I know you're very familiar with this.
Yeah, I wrote the story. I could tell you all about it.
Please, Molly.
She's talking her own book.
We're getting firsthand insight here.
Sure. So, it looks like home builder sentiment. So this is a gauge from the National Association of Home Builders as well as Wells Fargo that they put out this measure. And home builder sentiment rose by the most in nearly a year in January, just continuing to see the benefits of mortgage rates paring it back. But we still got a ways to go. Rates are still considerably elevated, more than where we at, still twice as high as they were, 2 years ago. So there's still a ways to go for the housing market to climb back. But really the inventory is still so much of the story here. So as long as builders are feeling good, that should certainly help on the supply side.
Well, I heard earlier this morning one of the real estate experts or the mortgage experts saying that 5% was the key number. That's when everything's going to go back to gangbusters in the housing market.
We have a bit further to go to both of your points. Redfin reported that Gen Z's home ownership rate stagnated in 2023, but millennials and Gen X saw gains. I found that to be really interesting, especially...
they're older.
Yeah, they're older. They're a little bit more...
Who in Gen Z is owning a home right now? Tell me that.
I don't think any of us
as
can
a millennial who is close to owning a home, but I would love to know.
I don't even know what Gen Z is.
Your kids?
It's me.
No, they're younger. Oh, Miss Nora over here.
Okay, all right, whatever. I don't know what I am.
Might be a minute before we get a house.
Gen Z, Nora Melinda, thanks very much for stopping by. All right, so the data we got today, that was an eye-opener. I actually sent you a headline, just writing up the possible stories we're going to do today, that U.S. consumers are not falling off a cliff.
And
that
said, stand by. I said, stand by. Let's wait and see. And look at that. John Tucker's crystal ball right on the mark today.
Bloomberg International Economics Policy Correspondent Mike McKee with us. I was dead on. I was actually accurate about something. To which Molly said, don't get comfortable with that.
The entire Bloomberg workforce is standing outside the studio applauding you now.
All right, so why this is some hard data. Why is it so off the expectations, the retail sales number for today?
Interesting question. The holiday spending numbers are always kind of hard to define, and then you get all kinds of people who are putting out, here's what the holiday spending was, and maybe some gloom or pessimism permeated those. it's hard to really predict retail sales because they're very volatile and they get revised quite a bit. Although, oddly enough, this month they weren't. It seems that the American consumer did not listen to the gloom and went out and filled their Christmas stockings and
with a credit card.
Could be.
Could be.
We don't know about that from this report, but I mean, could look at a few others and put two and two together.
Okay, so is this well? It's not Fed friendly, is it? How's it being interpreted?
Well, it depends on how you define your friends.
Fed. Fed friendly, not Fed.
Fed friendly. Well, it does support the Fed's argument that they're not going to be cutting rates as rapidly as the market thinks, although the market still doesn't believe them. We have backed off a little bit from 7 rate cuts now to 5.7 rate cuts. So there's been a little bit of pushback, but not a whole lot yet. But this just tells you that the economy was relatively strong in the fourth quarter. We're all kind of waiting for the Atlanta Fed's GDP Now number to come out, the latest one. We get the GDP for the fourth quarter number next Thursday, and it's a week from tomorrow, and it's forecast to be 1.5%, but that's going to go up after this number today. So the strength just suggests that there's still a question about whether inflation is an issue, and as long as there's a question, the Fed is going to be cautious.
That's what I was waiting to see, that, this data came out like over an hour and a half ago, which is kind of a long time in terms of being able to update your GDP forecast. And we haven't really seen any economists say that yet, at least none that I've seen come through my inbox. And the reason why, as you were just alluding to, Mike, there's something out of the retail sales report. It's called the control group sales. So this is just a stripped down measure that's helped to calculate GDP. So, I mean, we should start to see some of those predictions come out today, right?
Well, I'm not sure if you'll see predictions necessarily come out today. Since the numbers next week, they'll probably take a day to calculate, recalculate.
Everyone's taking their time.
And then they'll put it in their their weeklies. But you'll probably get some people alluding to it in their commentary today. And we'll see what happens with the nowcasts that are coming out and see how much the people who compile on a day-to-day basis think that things have changed. But just mathematically, it's going to raise the forecast because when you do a forecast, you're basing it on what you think the numbers will be. In this case, the numbers were all double what the consensus was.
I don't want to get too in the weeds, but who was it? Michelle Bowman of the FOMC was saying that she really closely looks at revisions to the hard data. The suggestion there is that maybe the Fed thinks the hard data is kind of not accurate, or is there a problem with it?
The data are frequently revised for just about everything because the response rate, you send out your questionnaires or you ask for your data and you get half of it in. That's what happens with retail sales. They get about half of it in and they put out the number, and then they have to revise it the following month when they get a full set of data. And we see that with everything. You look at the jobs report's been revised. 9 out of the last 10 months revised down as more data comes in. The Fed has to make a decision based on what it knows at the time. And a lot of this data gets several months down the line. And so the Fed wants to know if the data they were using was in any way accurate.
But a lot of this data has consistently been revised downward, has it not?
Not consistently. We've seen strength in a lot of areas over the past year. Third quarter numbers were very, very strong. And so
Taylor Swift.
Well,
among other things.
We disagree about that. Although, she's probably doing wonders for Kansas City Chiefs merchandise sales. But the overall feeling was we were going to see a slowdown in the fourth quarter that we haven't really seen yet, a major slowdown. So it's kind of interesting that the economy is just held in despite what everybody's anticipating. And a lot of people thought at the Fed that we would see a slowdown because interest rates went up, but they haven't really had an impact.
What was everybody buying? I guess vacations to Mexico and Antarctica.
No, see, this one is only really goods spending, not services.
Oh, stuff. So
this
it's
is the stuff. You're right.
The
so
vacation
this was the
in
bigger
Mexico
ones.
didn't count.
This one was mostly clothing, department stores were up a lot, and e-commerce as well. You got anything from Amazon last month?
No. I gotta
Okay,
get
so
an
John
Amazon
didn't help the
account.
economy last month.
I'm not like in
Well,
any way
and
any
eating
bellwether.
and drinking places were flat, so John did not contribute.
He really didn't.
But that's services. What are you talking
That's
about?
the only service in the report. The other ones are all goods. But, you know, this was an interesting reaction from our Bloomberg economics team that I wanted to ask you, Mike, because I wasn't really sure about this, that they were saying that the print doesn't dispel our caution about the U.S. outlook, as we've noted that consumption doesn't necessarily fall in a downturn. Can you explain that to me? How would consumption not fall in a downturn?
Well, I'd have to look at the numbers they were looking at, but basically what you see is that as long as you have a job, you keep spending. I mean, consumption overall falls because unemployment goes up, but if unemployment's not going up, you're not going to see that happen.
Well, is that a downturn then?
Well, you can have a. We haven't had a recession where unemployment hasn't gone up.
That's what I'm saying. I don't see it.
So
Where's the downturn?
that's what I don't see either. But remember, our dear friends at Bloomberg Economics, and they're very talented, smart people, said we were in recession starting in October, and people don't see that. So you could have revisions, as John said,
and then we'll be in a recession.
And then we'll be in a recession, and then we'll all tell them we're sorry.
But you don't know you're in a recession until like months and months later.
Correct. Yes, our good friends at the National Bureau of Economic Research take their sweet time.
The official
in telling
dating
us.
people.
Well, the reason they
like
take
there's
it,
a 30% chance it's already raining. You know that reference?
The reason they take their time is because they're waiting for revisions, and revisions can take a long time, and it could be that we're miserable right now and we just don't know it.
Oh boy.
Oh, thanks. I know I am. I know it. Mike McKear, what's your title again? International Economics Policy. Does that fit on your your business card? Probably not.
You know, the other day I was thinking, when was the last time anybody used business cards? It was before the pandemic, I think. Since the pandemic.
Mine doesn't say a title on it. It just says news.
Mine doesn't have a title. I have the same one you have.
So says Twitter. Probably needs to be rebranded to X.
That's probably true.
Yeah.
All right.
I have the
Off
same
on a
business
tangent.
card as Molly, except mine doesn't say Molly.
All right, Mike, thanks a lot. S&P 500 right now, 33 points lower. That's down 0.7%, 4732 on the index. The Dow Jones Industrial Average, 88 points lower. That's down about 0.25%. The NASDAQ 100, 228 points lower. That's down 1.4%. The two-year yields, which are more policy reactive after the economic data, those are up right now 13 basis points. The yield at 4.35. 10-year yield, the benchmark is up 5 basis points. That's at 4.11 right now. You are listening to Bloomberg Markets. John Tucker, Molly Smith along with you, in for Matt and Paul. And that brings us to 10:18 on Wall Street. Let's get the company news now with Steve Rappaport.
John, shares of Spirit Airlines continue to slide after a judge blocked JetBlue's proposed acquisition of the budget carrier. Bloomberg's Charlie Pellet reports.
U.S. District Judge William Young sided with the federal government and said the merger would harm cost-conscious travelers by eliminating the nation's dominant deep-fare discount airline and drive up prices across the industry. The ruling follows a closely watched trial in November where lawyers for the government argued that the merger would eliminate a key incentive for bigger airlines to offer budget-friendly fares. JetBlue and Spirit contended the consolidation was the only way that smaller airlines can effectively compete with the dominant carriers. In New York, Charlie Pellet, Bloomberg Radio.
Thanks, Charlie. Apple is opening its App Store to allow outside payment options. More on that from Bloomberg's Jeff Bellinger.
Steve, Apple made the move after the Supreme Court rejected the tech giant's appeal in an antitrust lawsuit challenging its business practices. Apple will allow all third-party apps sold in the U.S. to include an outside link to a developer website to process payments for in-app purchases. That will bypass Apple's own payment system, which charges developers a commission of either 15% or 30%. Apple will warn customers when they press a link to conduct purchases outside the App Store before letting them proceed. Steve?
That's Bloomberg's Jeff Bellinger reporting. Shares of Apple down less than 1%. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager, and we check the markets all day long on Bloomberg. Right now, the S&P 500 is down 36 points, or about 0.75%. Dow Jones Industrial Average is lower by 81 points. That's a drop of about 0.2%. The NASDAQ 100 is down 1.4%, a drop of 237 points. 10-year yield up about 6 basis points to 4.11%. The 2-year is at 4.35. That's after we got that stronger than expected retail sales data, up 0.6% in the month of December, its strongest pace in 3 months. It's got the market dialing back expectations even further that the Fed could cut rates by March. Looking at commodities, NYMEX crude is down 1.3%. That's 95 cents lower at $71.48 per barrel. COMEX gold is down 0.8% or $16 at $2,014.10 per ounce. The euro, a little bit weaker against the dollar at 1.0855. The yen is weaker as well at 148.29. U.S. wage growth is on track to slow to around its pre-pandemic level over the next few months. That's according to data we just got from the job search website Indeed. If it stays on that track, it would relieve one source of inflationary pressure that has been a concern for the Fed. That's a Bloomberg Business Flash. Bloomberg Markets continues with John Tucker and Molly Smith.
Nathan Hager, thanks very much. Appreciate it. Well, risk assets, that Nathan just said, they're under pressure today. Investors questioning the timing of Fed rate cuts, among other things. And with that context, let's bring in our next guest, Molly. Ron Sanchez, the Chief Investment Officer at Fiduciary Trust International. Hi, thanks for stopping by.
Great, thank you. Thanks for having me.
So what's in the driver's seat?
Well, from a market standpoint, I think markets are sort of languishing a little bit here because there isn't a catalyst. We had, as you well know, markets ended the year on a strong note. We already have seen the two important economic data for January. That was the labor report and CPI. So at this point, I think the focus turns to earnings. We've seen a couple of bank earnings, but we will see earnings over the next 2 to 3 weeks that'll give us an idea about how the macro is filtering into the micro, and perhaps more importantly, CEOs' expectations for 24.
Give us a little sum of what we saw from the bank earnings and what your biggest takeaway was from that.
Yeah, so almost status quo. As we expected, nothing alarming, and economic activity and the banking system remain in good shape. And I'm not sure that sort of bank earnings signal much on the macro. We have to wait for other companies.
Well, for sure, maybe the last mile is going to be real difficult to get to the Fed's target of 2%, but we are in a disinflationary, or in some sectors outright deflationary environment. What does that do to earnings?
Well, it creates 2 things. I think it's going to be much more challenging to pass on, and so revenue and profit margins are going to be needed to sort of
pricing
be
power
maintained.
Evaporates for
it
some?
does indeed. It does indeed. I think there's after 2 years of where not only did you pass on rising input cost, but a little more. And I think that environment is clearly behind us. I think it's much more challenging. And if you do raise prices, you could see it manifest itself in lower volume. So there's that trade-off between sales volume and sales revenue.
But prices are still going up, no? I mean, yes, at a slower rate, but I mean, there still is some pricing power there, maybe just not as much.
There is, and I think as we move on, it'll be less and less. And so